Good morning, everyone. I hope all of you are doing well, and I'm doing well as well. So, welcome to this advanced accounting marathon where we will be focusing on amalgamation followed by consolidation and then internal reconstruction, and if time permits, associates and joint venture. The idea of this marathon is to ensure that just a moment. The idea of this marathon is to make you ready for the examination. So we will revise all the concepts and we'll look at some of the problems that will make you confident for the examination. And before I start this marathon, I would like to thank all my teachers because of whom I am here today, and also all of you students, because if there are students, then there are teachers, right? So on this Teachers Day, I would like to be sharing my gratitude with all my teachers and also all the students because of whom we are here, what we are here today. Now, couple of things before we move on to the actual discussion. First, if you have not yet subscribed to the channel, please subscribe to the channel so that in future, whenever we conduct any marathons, we come up with any updates, you will be able to follow those updates on a timely basis. Second, if you have not yet downloaded our app, please download our app, because from there you can get the notes, past exam papers, forums to ask questions, for practice MCQs, have a study planner customized according to your needs. All of those are available on our app, so please download the app. And without wasting any more time, let us continue with our discussion. A quick check if you are able to hear my voice clearly, and if you are able to see the screen. I have not yet written anything. Please give a thumbs up or put a comment down there. That will help me understand that yes, you are able to follow. Good morning, Reshma. Thanks, Nandini. Thanks, Yogeshwari. Chitra. This is a marathon covering all the concepts and some specific questions for your examination. Now, coming to the two topics first that we will be starting with. The first one is amalgamation, and the second one is consolidation. Amalgamation covered by Accounting Standard 14 and consolidation as covered by Accounting Standard 21. Now, the thing is, these two topics in the new syllabus, if you see, 14 marks question can be expected from both these chapters. In one odd case, they may not ask either amalgamation or consolidation, but in most of the cases, you will get 14 plus 14, a total of 28 marks out of 70 marks. This is 40% of your paper. And with my experience of being an examiner, what I've realized is that if you take care of few small things, which I will be covering in the video, you can easily score 8 to 10 marks, even if you make one or two silly mistakes. And the second thing is, this is one chapter, I think these two chapters, I would say, these are one of the scariest chapters for the students, because they think amalgamation means a big chapter, consolidation is a big chapter, big problems. But let me tell you, friends, for a 14 marks question, institute cannot set a very long questions except one odd circumstances. Most of the questions will be simpler, straightforward, and if you are able to do the adjustments and working notes correctly, these two can be the highest scoring questions for your examination. Just think of it, no? Out of 28 marks, if you are able to score 20 marks in these two questions, some 20 marks in your MCQs, the passing requirement can be met. And I can prove it to you. How is that possible? By explaining it to you. How will the examiners give marks in the examination, right? So that is what is the entire objective of this particular discussion. Now, looking at a purely examination point of view, when we talk about either amalgamation or consolidation, 2-3 common points. You will be given 2 companies or sometimes 3 companies, but most of the cases 2 companies only. You will have balance sheets of both the companies, right? And the balance sheet will be in a standard format. So while reading the question, you should not be wasting time in understanding the balance sheet. Okay, so you'll have, let's say, A Limited, B Limited. Here also you may have, let us say, P Limited, S Limited. 2 balance sheets would be given, and you will have some adjustments. And based on those adjustments, you have to calculate certain items and prepare the consolidated balance sheet or prepare the balance sheet of the amalgamated companies. Now, a lot of students waste a lot of time in thinking about how to prepare the balance sheet. So if a question has, let us say, amalgamation, one part is your balance sheet, second part is your working notes. If you can crack these working notes, balance sheet is the easiest thing to do. Okay, and same thing with consolidation. If you are able to do the working notes, balance sheet is the easiest thing to do. So there is a lot of commonality between how you should approach amalgamation and consolidation. The first thing I told you, don't waste time in reading the balance sheet. Directly jump into the adjustments, pick out important information and start your working note. That is a purely examination approach that I am talking about. Right. Second thing, the common thing between both this chapter is you need to calculate first goodwill or capital reserve. Even here also you have to calculate goodwill or capital reserve. That is the first thing. To calculate goodwill, here you need something called as purchase consideration. Here you will get something called as cost of investment. Both of them are more or less similar. Then you need net assets. Here also you need net assets. So see, a lot of things, if you can approach in a systematic manner, you will be able to figure that out. And we will see how to handle each one of these when we do the chapter and the questions. Then after you do this, there are some adjustments, upstream transaction, downstream transaction or intercompany transactions, whatever it is, in both the cases. Then you have to prepare the balance sheet. Now when you prepare the balance sheet, in both the cases, you simply have to take A plus B, and here you have to take simply P plus S. Of course, there are some items to be excluded, some items to be included, but your 90% of the balance sheet will be what is there in the question. 90% of the balance sheet will be what is there in the question. And let me tell you, balance sheet and the notes to accounts itself will carry somewhere around 7 to 8 marks. So even if you do 1 or 2 adjustments wrong, but if you are able to draw up the balance sheet, out of the 7 to 8 marks, 4 to 5 marks can be easily scored. So that is the understanding with which we should approach this chapter from an examination perspective. See, you understand the logic, you understand how things work, but from a purely examination point of view, you have to remove the clutter, you have to remove the extra things, and you should focus on balance sheet, adjustments, and how am I doing step by step each of those adjustments and prepare the consolidated balance sheet. A lot of students come to me and say, sir, my balance sheet doesn't tally. If they have given you a tallied balance sheet, and if you take care of all these adjustments, how is that your balance sheet will not tally? It has to 100% tally. And tallying the balance sheet should be the last problem in the examination. Okay, as a student, I was also scared of these two chapters. But while I was correcting papers, what I realized is students lose marks because of some silly computational mistakes. Other than that, this chapter can be handled easily. So now, let us start with the first standard, that is amalgamation of companies. If you want the notes, you can download it from our free resource section. And if you have any question, if you increase the volume, okay, Ammu, just a moment, I'll see the mic. Just give me a moment. Okay, is it better now, Ammu? If you can confirm. Thanks everyone for the Teachers' Day wishes. Thanks Ankita, thanks Deepa, thanks Manoj, thanks Harini. Can you please confirm if the audio is better now? Okay, I assume it's better unless somebody comes back and says, no sir, it is not better. Okay, yeah. So first we'll start with amalgamation of companies, and it is covered by which accounting standard? It is covered by accounting standard 14, right? Now, what is amalgamation and how does it work? Basically, what happens is when we say amalgamation, there are two companies. Let us say Vodafone and Idea. Vodafone and Idea. When we say amalgamation, these two companies are coming together. Now, there could be multiple scenarios in which amalgamation can happen. One is Vodafone purchases Idea. So, Vodafone purchases the business of Idea, or Vodafone purchases all the shares of Idea. So, that is one possibility. Vodafone acquires the business, or acquires the business, or Vodafone acquires the shares. Okay, by doing that they can amalgamate both these companies. Generally, when we have acquisition of shares, the other company becomes a subsidiary, and that is covered as a part of consolidation. So let us say Vodafone decides to acquire the business of Idea, and they want to shut off the brand called Idea or the company called Idea, and they want to continue as Vodafone. This is one way of amalgamation, which we also understand as acquisition. Other thing possible, what has happened is Vodafone and Idea, they come together and they formed a new entity called Vodafone Idea. This is also amalgamation. Okay, so when we say amalgamation, two businesses are coming together, two businesses are merging, or one business is acquiring another business, or one business is absorbing another business. There are different varieties. Basically, there are two companies, and one company has acquired the business of another company, or two companies have come together to form a new entity. And this kind of transaction, when it happens, the accounting of that is given by Accounting Standard 14 on amalgamation. So, amalgamation basically is the combination of two or more companies into a single entity. Okay, so there are multiple ways to say, you call it amalgamation, you call it absorption, you call it external reconstruction. Generally what happens is when we say amalgamation normally, or when we say merger, two companies come together, form a single entity. Okay, absorption, one existing company takes over the business of another entity. So for example, if you have, let us say, Kotak took over the business of ING Vaisya Bank. Now this entity no longer exists, we only know Kotak Mahindra Bank, right? So that is in the form of absorption. Then external reconstruction, generally it happens when a new company takes over the business of one or more existing companies. This can be important from a 2-mark question on an MCQ format. Okay. Now, the most important aspect when we talk about amalgamation is how to do the accounting for amalgamation. How to do the, okay, you want me to increase the volume? I'll increase it slightly more. Just give me a moment. Just give me a moment. Okay, so I hope it got more amplified. Now, the most important part when it comes to accounting for amalgamation is we have to understand which type of amalgamation we are talking about. So, the accounting standard says there are two types of amalgamation. Number one, which is the first one? Amalgamation in the nature of merger, and the second one is amalgamation in the nature of purchase. So, there are two types of amalgamation: in the nature of merger, in the nature of purchase. Now, in the examination, they may give you what is the type of amalgamation, or if they don't give you, you have to see the conditions and identify whether it is amalgamation in the nature of merger or whether it is amalgamation in the nature of purchase. And based on the classification, our accounting will differ, right? If you know the answer, if it is amalgamation in the nature of merger, what type of accounting do we follow? Please put it in the comment. Now, when it comes to merger, we have to satisfy these 5 conditions. All the conditions must be satisfied. Now, what are those conditions? The first condition, a very important condition, all the assets and liabilities of the transferor company become the assets and liabilities of the transferee company. Meaning to say, whatever business assets, liabilities the transferor company has, it has to be the asset liabilities of the transferee company. Now, there are other names also which are used. One name can be buyer, the other one is called a seller. Then you can also call this a vendor company. Okay, then this is the transferor company. This is the transferee company. This is the acquirer. The other one is called the acquiree. See, different names can be given. What you have to understand is the assets and liabilities of the selling company has to become the assets and liabilities of the buying company. This is the first condition. Second condition, shareholders holding not less than 90% of the face value of the equity shares of the transferor company become equity shareholders of the transferee company. Means 90% of shareholders of the selling company. Okay, so let us say if you take two companies, I'm just giving a hypothetical example. Vodafone and Idea. Assume Vodafone is the buyer, Idea is the seller. 90% minimum shareholders of Idea have to become shareholders of Vodafone. That is the second condition. Then the consideration of amalgamation receivable by equity shareholders, these equity shareholders of the transferor, is discharged wholly by the issue of equity shares in the transferee company. Okay, so what you have understood? First, assets and liabilities have to 100% be transferred. Idea is to give all the assets liabilities to Vodafone. Second, all the shareholders, 90% of the shareholders have to become the equity shareholders of the new company. So if Idea has 1000 shareholders, or let's say 1000 shares, at least 900 in terms of face value. Okay, so there's 1000, at least 900 shares or 900 face value worth of shares have to continue to become shareholders in Vodafone. It is not the number of shareholders, it is the face value of shares. So if the shares is 1000, 900 has to become the shares in Vodafone. That is the second condition. Third condition, if it is 900, whatever amount we are giving to them, see, when you acquire a company, you have to give them some asset, you have to give them some new security, you have to give them some new instruments. So if I'm buying another company, the company will not come for free. I have to pay something to the shareholders of the selling company. What can I pay? I can give them cash, I can give them assets, I can give them new liabilities, I can give them new equity. Now what the standard says is, for amalgamation in the nature of merger, you cannot give cash for all of these things. What do you have to give? You have to give equity shares. You have to give wholly by issue of equity shares. Everything what you have to give is to be equity shares. Whose equity shares? Equity shares of the buying company or the new company. So Vodafone has to issue equity shares to 90% of face value of shares in this process of amalgamation. Now sometimes what happens is, there is a fractional shares. When you calculate, some fractional shares may be left. Okay, let us say the ratio is 1:3 and there may be some 0.3 shares which are left. For fractional shares, cash may be paid, but otherwise you have to pay, otherwise you have to issue shares only. Then the business of the transferor company is intended to be carried after the amalgamation by the transferee company. Now this generally is not given in the question, we have to make an assumption. If it is given, well and good. And lastly, no adjustment is intended to be made in the book values of the assets and liabilities of the transferor company when they are incorporated in the financial statements of the transferee company, except for uniformity in accounting policy. So just to zoom out, first, all the assets and liabilities you have to transfer. Then, by virtue of this thing, it has to be transferred at book values. You should not make any adjustment except for accounting policy differences. Okay, so asset liabilities transfer 100%. At what value? Book value. Then 90% of the face value of equity shares have to continue in the new entity, and you have to give only equity shares to the shareholders. Cash may be paid for fractional shares, and the business has to be carried on by the amalgamated company. So if all these 5 conditions are satisfied, we say it is an amalgamation in the nature of merger. If the conditions are not satisfied, if any condition is not satisfied, then we say amalgamation in the nature of purchase. Now, what you have to remember is, if it is amalgamation in the nature of merger, for this we follow something called as pooling of interest method. And for this, we follow the normal amalgamation or the purchase method. Okay, so pooling of interest method and purchase method. Now, in the question, if they don't give you, you see if any hints of these are given. For example, if the question says you have paid cash to acquire, then it will not be a part of amalgamation in the nature of merger. Or if the question says, all the assets and liabilities are not taken over, then also it will not be an amalgamation in the nature of merger. If they say value changes while calculating net asset, then also it will not be amalgamation in the nature of merger. Right? So that is the first thing what we have understood, 2 types of amalgamation. Now, when Vodafone purchases from Idea, we said Vodafone purchases Idea. Idea is owned by shareholders. You have to give something to the shareholders to buy the business. So what all can we give to the shareholders? You can give them cash. Take this 1000 crores, give your business to us. You can say, I will give you shares of Vodafone. I will transfer any other asset. I will give you some form of debentures. Anything. Any asset, any cash, any equity instrument, any other liability, whatever Vodafone gives to the shareholders. Now here when I say shareholders, it is both all the owners, equity as well as preference. If I give it to the shareholders, then in that case, this amount that is given to the shareholders is called purchase consideration. Now students have some confusion here. Sir, if equity shares are there, equity shares of idea, and to this equity shares, if we issue debentures, is that a purchase consideration? Yes, it is a purchase consideration. Then there are some debenture holders. To these debenture holders, we give equity of the new entity or equity of the buying entity. Is this a purchase consideration? This is not a purchase consideration. This is one mistake what a lot of students make in the examination when they get confused. If I am issuing equity shares, I consider everything as purchase consideration. That is not the right approach. Only what I am giving to the equity shareholders. What all can I give? Cash, shares, asset, debentures, whatever it is. Whatever I give to the equity, the owners, the shareholders, that is what is called the purchase consideration. What am I giving to the debenture holders or liabilities? Even if I am issuing equity shares, that is not considered to be your purchase consideration. So that is one thing you have to keep in mind. Purchase consideration is aggregate of shares and other securities. Other securities could be debentures, it could be preference shares, and the payment made in the form of cash or other assets by the transferee company, that is the buying company, buyer, to the shareholders of the transferor company is what is called purchase consideration. What you should include? Anything paid to equity and preference shareholders. What is not included? Whatever you pay to the others. Okay. So that is what you have to understand when it comes to purchase consideration. This is very important because this will determine how you calculate goodwill or capital reserve. If this goes wrong, then your goodwill and capital reserve calculation also goes wrong. So you have to be very careful while calculating the purchase consideration. So in the question, when they say we have issued these many shares at this value, very, very carefully you have to see how do we calculate, right? Now, there are different methods. This is more for theoretical understanding. From examination point of view, I will tell you how to handle each of the scenarios. One is a lump sum method, which is the most easiest method, where they say, okay, we will buy for 1,000 crores. Now, when we will buy for 1,000 crores, there is nothing to calculate. The question itself will say, a Vodafone acquired Idea Limited by paying 1,000 crores or by issuing shares of 1,000 crores. So that is solved, and this will not come in the examination. Then you can issue shares, debentures, cash or any other assets to the equity and preference shareholders of the other entity. Okay, so here a lump sum fixed amount is told. Here you will give some cash, you will give some other assets, you will give some equity shares. So important is this has to be valued, and the value will be given in the question. Accordingly, you have to calculate the purchase consideration. Now, students where they face challenge is this net asset method. Now, what is the meaning of net asset method? I'll just give you a brief of that. Let us say Vodafone and Idea. Okay. Now Vodafone and Idea has some assets of 5,000 crores. Vodafone has some liabilities of, let us say, 3,000 crores. This is the book value. Now what they'll say is, for the purpose of amalgamation, the companies will agree these assets, let us say, have a value now of 6,000 crores for amalgamation purpose. Liabilities are kept as 3,500 crores. So this 6,000 minus 3,500, 2,500 crores, this becomes the net asset. And Vodafone will issue shares or will transfer cash, assets, all of those things to satisfy this 2,500 crores, which becomes my purchase consideration. Now while calculating net assets, you have to be carefully see all the assets, all the liabilities at the agreed value. You have to consider the agreed value, not only the book value. If nothing is given, book value will be the agreed value. If an information is given, you have to take the agreed value. Second, you will only take assets and liabilities. You will not take equity, or you will not take preferential. This is not taken. Only assets and outside liabilities. The net amount becomes your purchase consideration. Okay. Now, sometimes students have a doubt that, sir, how do we identify whether you have to follow the net asset method or whether we have to calculate, whether we don't have to calculate. You have to read the question. For example, if the question says Vodafone issued 5 shares for every 8 shares in Idea. The shares are valued at rupees 15 per share. Now here they have said for 8 shares in Idea we will issue 5 shares. So if Idea has 2000 shares, how much will we issue? Vodafone will issue 2000 divided by 8 multiplied by 5. Okay, so 2000 divided by 8 multiplied by 5, if I do 2000 divided by 8 multiplied by 5, they will issue 1250 shares. At what value? 15. So you multiply it with 15, you will get the purchase consideration. We'll do a couple of questions on this so that you have more clarity. Okay. Now, if this is not given, and if they have not told total purchase consideration, then you may have to follow the net asset basis. What is the net asset being taken over? And accordingly, you will say that, okay, this net asset, whatever is the value agreed, that is the purchase consideration. Right? So there is also something called as intrinsic value or share exchange method. Here, what you will do is, you will take the intrinsic value of transferor and of the transferee, and depending on that you will calculate what is the exchange ratio, similar to net asset basis. But here you will see what is the intrinsic value of the buying company, what is the intrinsic value of the selling company, and based on that you will arrive at a exchange ratio. Okay, so that is your basis when you use the intrinsic value or share exchange method. Just to elaborate on this, let us say we have Idea, you have Vodafone. Idea has net assets of 5000, number of shares is 2000. So it becomes intrinsic value is net assets divided by number of shares, 2.5. Vodafone has, let us say, 15,000 net assets, number of shares, let us say 5,000. So intrinsic value is 3 per share. Now what you will do is, this is 2.5 per share, this is 3 per share, and accordingly using these two ratios you will see how many shares have to be issued. For example, if the net assets is 5,000 and if the intrinsic value is 3 per share, you have to issue 5,000 divided by 3, the number of shares. Okay, or if these two companies are taken over by a third company, then you will see in this ratio you will do the share exchange. So when we do a question on this, you will have more clarity on this. The thing you have to keep in mind is intrinsic value is net assets divided by number of shares. So that gives us intrinsic value, and then based on this intrinsic value we will calculate the swap ratio or the exchange ratio and do the calculation. Now what we will do is, we will take a question, and we will see how to calculate the purchase consideration. So this is the format what we follow in the class. If you have seen our lectures, paid to equity shareholders, preference shareholders. So whom did we pay to? What is the form of payment? What is the amount? This will give us the total purchase consideration. A few things. You will include assets of cash, bank, unless it is given that it should not be included. You will include goodwill, prepaid expenses, unless otherwise it is stated. So unless they tell something, if cash is given, if cash at bank is given, if goodwill is given, if prepaid expenses is given, this will be included in the asset. You will not include assets not taken over and fictitious assets like preliminary expenses, underwriting commission, discount on issue of shares or debentures, P&L loss account debit balance. These you will not include in the calculation of net assets. Same way, liabilities only to third parties, and you will not include liabilities which are not taken over. Okay, so this is one thing you can keep in mind for your revision purpose. So let's look at a couple of questions. Yeah, simple one only, but we'll have absolute clarity after we do these 2-3 questions. Let us consider the draft balance sheet of X Limited on 31st March of 2011. Share capital, equity shares, preference shares, general reserve, 12% debentures, trade payables, land, plant, furniture, investment, inventory, trade payables, cash and bank balance. Y Limited takes over X Limited on 10th of April. Debenture holders of X Limited are discharged by Y Limited at 10% premium by issuing 15% owned debentures of Y Limited. Now, whatever we are paying to these debenture holders, will that form a part of our purchase consideration? Will we say that it is a part of our purchase consideration? It will not be considered to be a part of our purchase consideration. So, this will not be included. 14% preference shareholders of X Limited are discharged at a premium of 20% by issuing necessary number of 15% preference shares of Y Limited, face value 100 each. Now what does that mean? We have 14% preference shares of 100, right? Now that we have to discharge by at a premium of 20% by issuing necessary number of 15% shares of Y Limited, face value of 100 each. So what does that mean? Whatever we have, 2500, we will add 20% premium to that and we will issue the shares. This has to be 20%, not 25%. So you have 2500 preference shares into 1.2 you can do, or you can say plus 20% of 2500. So 2500 plus 20% of 2500 is 500. That makes it 3000. Okay, so the first number is 3000 here, right? How many shares to be issued? 3000 divided by 100, you will get the number. These numbers are given in thousands. Then intrinsic value per share of X Limited is 20 and that of Y Limited is 30. Y Limited will issue equity shares to satisfy equity shareholders of X Limited on the basis of intrinsic value. Nominal value of each equity share of Y Limited is 10. Compute the purchase consideration. Now, what is the intrinsic value we have calculated? Intrinsic value of X is 20. So here if you see, intrinsic value is 20, right? Now, what is the total value? Intrinsic value is 20. So we have 7500 divided by 10, 750 shares. So the total value comes to 750 into 20. So the value that is determined is 15 lakhs. How did we get that again? See, we have 7500 in total number. Number of shares is 7500 divided by 10. We have 750. 750 is the number of shares. This 750 multiplied by 20 will give the total value. So 750 multiplied by 20, if you ignore the last 3 zeros, you get 1500. You get 1500, right? That is the total value. But what is the intrinsic value of Y Limited? 30. So what you will do? 1500 divided by 30, you will issue 500 shares. Okay, when I say 500, 500 add 3 zeros. 500 shares. But what is the purchase consideration? 500 into 30. 500 into 30, that is 15 lakhs. That becomes your purchase consideration here. I think this total is incorrect somehow. Okay, 15 lakhs plus here we got 30 lakhs. So the total purchase consideration becomes 45 lakhs. Okay, ignore this total, some error there in calculation. So here we saw how do we calculate based on intrinsic value. Two intrinsic value are given. You will see what is the total intrinsic value of selling company divided by intrinsic value of buying. This will give me number of shares to be issued. Okay, so that is how we follow the intrinsic method. Any question, please feel free to ask while the live discussion is going on, so that if at all you have some doubt, I can address it immediately. The second question, S Limited is absorbed by P Limited. So when we say S Limited is absorbed by P Limited, which is the selling company? S Limited or P Limited? Which is the selling company? If S Limited is absorbed by P Limited, which is the selling company? S is absorbed, so P has bought and S is sold. The draft balance sheet of S is given below. Share capital, preference shares, equity shares, reserves, debentures, trade payables, sundry assets. P Limited agreed to issue 9% preference shares of 100 each in the ratio of 3 shares of P Limited for 4 preference shares of S Limited. So, how many shares do we have here? Preference shares, 2 lakhs is the value. Number of shares. So, I'll do a fair working so that you can follow it properly. Preference shares value is given to be 2 lakhs. Then you have 2000, number itself is given, sorry. So 2000 number itself is given. So if I need to calculate number of shares that will be issued for this preference shares will be 2000. Now very carefully you have to see, for 4 preference shares means for every 4 I am issuing 3. For every 4 I am issuing 3. So for 2000 I will divide it by 4, multiply it by 3. So 1500 shares will be issued. To issue to the debenture holders in S Limited, mortgage debentures at 96 in lieu of 6% debentures in S Limited, which are to be redeemed at a premium of 20%. Now, please keep in mind, they have given a very complex statement here. Something like this you would have heard or you would have seen in your internal reconstruction as well. But then, is this my purchase consideration? This is not my purchase consideration. Okay, this is not my purchase consideration. So, what is my purchase? This does not form part of my purchase consideration. So, that is not my purchase consideration. I don't need to even bother about this. To pay 20 per share in cash to issue 6 equity shares of 100 each. So, for equity holders for 5,000, you will pay 20 in cash and issue 6 equity shares of 100 each. When I say 6 equity shares of 100 each, for 5,000, 5,000 I will issue into 6, 30,000 shares of how much? Of 100 each. So what is the purchase consideration? For preference shareholders, 1500 shares. Preference shareholders, 1500 shares. At 100, 1,50,000. Second, equity shares. To pay 20 per share in cash. So 20 per share in cash and to issue 6 equity shares for every 5 shares. So divide by 5. If I do 5,006 divided by 5, 30 divided by 5, it is 5,000 into 6 divided by 5. So 6,000 shares. 6,000 shares at 125. So 6,000 into 125 is 7,50,000 and 5,000 into 20, 1 lakh. Right? So the total purchase consideration becomes preference shares issued, paid in what form? Preference shares, equity, cash. Cash is 5,000 into 20. This is 6,000 into 125. So 7,50,000, 1 lakh and 1,50,000. The total purchase consideration comes to 10 lakhs. This adjustment for debentures you don't even need to read in the examination. Maybe possible a couple of MCQ questions can come from this type of calculation of purchase consideration. So you will be able to score easily 2 marks. Okay, so that is one thing you have to keep in mind. So in the module they have given 80 lakhs as purchase consideration. I think that is we would have also taken it from the module itself, but this is not right because the total value is 15 lakhs plus your 30 lakhs. So that has to be the total purchase consideration. Right. So like this, do a couple of more questions for purchase consideration calculation. Now please remember, this purchase consideration calculation will be worth 2 marks in your final exam out of 14 marks. So when I say in the working note itself will be worth 2 marks. So you should not miss that part. Right. Now, once we have calculated the purchase consideration, what is purchase consideration? The amount that the buying company has paid to the shareholders of the selling company, that is called the purchase consideration. Now the next most important step that comes is calculation of your goodwill or capital reserve. For that we need to have a brief understanding, and this calculation of goodwill logic will also be useful for you when you are doing consolidation. Now, what is goodwill? You would have learned in partnership as well, and of course, because you have already done amalgamation, you would know it here as well. What is goodwill? If a business has net assets of, let us say, 1000. Business has net assets of 1000. I paid 1200 in form of cash, equity shares, and all of those things. This extra 200 that I pay is called goodwill. This extra 200 that I pay is called goodwill. Sir, no, I didn't pay 1200. 1000 is the net assets. I paid only 800. In this case, this minus 200, the less amount that I have paid, is the capital reserve. So goodwill is nothing but any amount that I pay over and above the net assets of the business that we have valued, that is called goodwill. Same concept works in consolidation also. See, there you have minority interest and all of that thing, but the core calculation, the basis of calculation does not change. Okay, so any amount paid in excess of the net asset is called an amount paid towards goodwill. And if you are buying a business at less than its net assets value, then the benefit that we get, see, if I am getting asset of 1000 and I am giving only 800, the benefit of 200 that I get is a gain to me, and that is called capital reserve. This is the second most important calculation when you come to amalgamation related problems. Okay, now how to calculate? See, first step, you will calculate purchase consideration. Second step, you will calculate net assets of the selling company. So if the purchase consideration is more, it is goodwill. If it is less, then it is capital reserve. Okay, that is one thing you have to keep in mind. Second thing that you have to keep in mind is when you are doing the pooling of interest method, there is no goodwill. When you are doing pooling of interest method, there is no goodwill. Goodwill will come only when you are doing the problem related to amalgamation in the nature of purchase. I am repeating once again, if you are doing pooling of interest method, you will not have goodwill. You will have only adjustments to reserves. But when you are doing amalgamation in the nature of purchase, that is when you will have goodwill or capital reserve calculations, which is relevant. Okay, now coming to the accounting, we have pooling of interest method and purchase method. Pooling of interest method is like saying that because the existing shareholders 90% continue to become the equity shareholders of the combined entity, we are actually not selling it to somebody else. The owners are same. So what they say is, when you follow the pooling of interest method, you will do everything at book values. That is what you have understood. All the accounting will be done at book value only. Whereas when you follow the purchase method, you will take the agreed upon value. When it is pooling of interest method, you will take the book value. When you take the purchase method, you will take the agreed upon value. That is the first thing. Second thing what you have to understand is, when it comes to pooling of interest method, this logic, if it is clear to you, you will be able to handle these questions not at this level itself, at a CA final level also. Okay, all of these concepts are relevant at CA final as well. So don't think that we'll only pass the inter exams and you'll forget everything. That is not the idea. Okay, now let us say we have P Limited, which has acquired S Limited. P Limited acquired S Limited. We have to follow pooling method, pooling of interest method. Now, if you look at S Limited balance sheet, you have some assets worth 2000. You have some liabilities worth 1500, and you have, let us say, some reserves worth 200, and you have equity share capital of 300. Okay, now this balance sheet is tallied, no problem. What P Limited has done is, P Limited has paid 700. P Limited has paid 700 to acquire S Limited. How much is paid? 700 is paid. Right? Now this 700 is called what? My purchase consideration. Very good. Now the thing that you have to understand is, when it is pooling of interest method, what P Limited has to do is, P Limited has to take all the assets, all the liabilities, all the reserves as it is. P Limited has to take all the assets, all the liabilities, all the reserves as it is and include in the balance sheet. So what happens? You will take asset 2000. So you will debit asset 2000, then you will credit liability 1500, you will credit reserves 200, and let us say you have paid 700. Now when I say paid, this is in form of equity share capital. So you will credit, I am directly writing equity share capital here, equity share capital, let us say 700. Now what has happened? 2000, 1500, 200, 700. So it is 2000, 1500 plus 2, 1700, 1700 plus 700. 1700 plus 700, this side it becomes 2400. So credit side is higher by 400. Now that amount which is higher by 400, you have to adjust in the reserves. So in reserves you have to do minus 400. In reserves you have to do minus 400. So the logic that is, whatever is the share capital or the purchase consideration issued and the equity share capital of the existing selling company, the difference 700 minus 300, the difference has to be adjusted in the reserves. So this is one thing you have to keep in mind. Any balancing figure, when you incorporate all the assets and liabilities, any balancing figure has to be adjusted in the reserves. Okay, generally it is adjusted in the capital reserve, and in the combined entity you will do that adjustment. That is one thing you have to keep in mind. There will not be any goodwill or capital reserve. Now you may say, sir, 2000 minus 1500, net asset is 500. We paid 700, 200 is goodwill. No, we will not have goodwill in the putting of interest method. If this was the purchase method, then you would have said net assets is 500, we have paid 700, 200 is goodwill. When we do the individual accounting entry, you will be able to do that, right? So coming back, pooling of interest method, when do we follow? We follow pooling of interest method when we use amalgamation in the nature of merger. Now amalgamation in the nature of merger, what you have to keep in mind is the assets, liabilities and reserves of the transferor company will be taken by the transferee company at carrying amount at book values only unless there is a difference due to accounting policies. This we have discussed. All the entries will be based on book values only. The difference between the share capital issued by the transferee company and the share capital of the transferor company has to be adjusted in the reserves of the transferee company, that is the buyer entity. So any share capital plus any other consideration. What could be the other consideration in case of pooling of interest method? Can you tell me? What could be the purchase other consideration when it comes to pooling of interest method? What do we issue? Yes, come on. In pooling of interest method, do we have any other adjustments or any other consideration that we can give? We will not have any other consideration other than cash for fractional shares. So this total consideration minus share capital in the transferor company, you will have to adjust the amount from the reserves. Now another thing you have to keep in mind, all the reserves, general reserve, capital reserve, any other reserve has to be taken over as it is by the purchasing company. The purchasing company will incorporate all the assets, all the liabilities, all the reserves as it is at the given book value. But when it is in the nature of purchase, then you have to calculate goodwill or capital reserve as the case may be. So as I told you, if the net asset is 1000, purchase consideration is 800, then there is a capital reserve of 200 under purchase method. If the purchase consideration is more, then it results in goodwill. Okay. Now, two things difference that you have to keep in mind. First, in the amalgamation in the nature of purchase, no reserves other than statutory reserves of the transferor company should be incorporated in the financial statements of the transferee company. When it is pooling of interest method, you will take all the reserves. When it is pooling of interest method, you will take all the reserves as it is and you will incorporate. When it is purchase method, you will not include all the reserves. You will not take any reserves other than statutory reserves, which you will take by passing this entry. What is the entry? Amalgamation adjustment reserve to statutory reserve. So you have to see in the question, is there any statutory reserve? If there is a statutory reserve, you will take by passing this entry amalgamation adjustment reserve to statutory reserve. So in pooling of interest method, you will take everything, whereas in purchase method, you will not take the reserves. Please keep this in mind. You will only take statutory reserves by passing an entry amalgamation adjustment account debit to the statutory reserve. I hope it is clear so far. Now we'll ignore the disclosure requirements and we will see what are the entries to be passed, and then we will move on to solving a couple of questions. Right now, generally in the examination, entries in the books of transferor company is not asked. Generally in the examination, entries in the books of transferor company is not asked. Sometimes they may ask, but most of the times it is in the amalgamated entity is when they ask the question. Okay, so in the books of transferor company, what you have to do is, as you would have done in case of dissolution of partnership, there is a balance sheet. You have some assets, you have some liabilities, reserves, equity, and you'll have cash as well. Right? Generally, what you'll do is, all the assets, cash you will prepare a separate account. All the liabilities you will transfer to an account called, these two will go to an account called realization account. So you'll open a new account called realization account. Assets have debit balance, so you'll transfer this to assets, to all the assets, all the liabilities. Okay, then this asset I am giving to the buying company, which is the acquirer. So what I will do, I will get the consideration from the the other entity. So what I will do, whenever I have to receive the consideration, that becomes my asset. Whenever I have to receive the consideration, that becomes my asset. So here I will include the name of the other entity, let us say A Limited, by A Limited, or by shares received from A Limited, whatever it is, I will put that in the realization account on the credit side, right? Then whatever is the gain or loss, this will be transferred to equity shareholders account. Then this reserve, this equity will also be transferred to equity shareholders account. If cash is taken over by the other entity, cash will also come to the realization account. If cash is not taken over, then whatever is the balance in cash, that will be used to settle the equity shareholders account. And from this entity, when we receive the shares, those shares will transfer to the equity shareholders account and close all the accounts. All the accounts at the end of entire exercise will be closed and you will not have any balances in any of those accounts. So if you see the entries quickly, transfer of business, realization account debit to asset account, all the assets, very important at book value, all the liabilities to realization account. If assets not taken over by the transferee company, if some assets are not taken over by the transferee company and we have sold those assets, so whatever amount we receive, we will credit that to realization account. If liabilities are not taken over, we will debit that to realization account. Okay. If cash is taken over, we will transfer to realization. If cash is not taken over, we will continue to open cash and bank account separately. Okay. Then purchase consideration, transferee company, that is buyer company A Limited, let us say, to realization account, we credit on the realization side. Then when we receive shares, debentures, cash, we will debit these respective account and credit the transferee. So what do we do with this? This will be transferred to equity shareholders account. Very simple. Okay. Then if there are realization expenses, if it is borne by transferee, the purchasing company is bearing. Do I have to do anything for that? I am not bothered about it. So no entry. If it is borne by transferor, debit to realization. So this realization account, think of it like a P&L account itself. After all the assets and liabilities have been transferred, think of it like P&L account, right? Where can I get the PDF? You can get the PDF from our resources section on the app. When I give a break, at that point of time, after we complete this amalgamation related part, I'll give a 10 minutes break. At that point of time, you can download. If borne by transferor, if I am buying and I am bearing it, then I will debit the realization account and credit the bank account. If incurred by the transferor and reimbursed by the transferee, means what? I am the transferor company. Okay, I am the transferor company. I have incurred, but they will reimburse. Then I will not debit it to realization account. I will debit transferee account, and when I receive, I will credit the transferee account. Okay, I will not put it to realization. If I am bearing, then I will put it into realization. Okay, if I sell any asset, the money received, credit to realization. If I pay any liability, including hidden liability, I will debit it to realization. Then, if there is any profit or loss on the transfer of business, that has to be transferred to the equity shareholders account, and finally you will close the account. Okay, now in the order, if preference shares are there, you will first close the preference shareholders account. Whatever is the balance left over, you will transfer to realization account. For example, preference shareholders are worth 100. We have to pay them 120. This 20 is the loss, right? This loss has to be transferred to realization account. Generally not asked in the examination. Any cash balance transferred to equity shareholders, and any realization profit or loss transfer to equity shareholders. Finally, whatever you receive from the transferee company, you will transfer that to equity shareholders. So the sequence in which it works is, again I am quickly repeating for you. First, all the assets and liabilities transfer to realization account. Then, if assets are not taken over and we have sold it, you will debit bank because you have received the money, credit realization. If you have paid liability, debit realization, credit bank. Okay. You will not pass any other entries in respective asset account. Then cash, if the buying company has taken over, I will transfer that to realization account. If they have not taken over, I will prepare a separate cash and bank account. Then any entries related to cash and bank, I will pass it through cash and bank account. Then the purchase consideration, I have to receive from the buying company. So I will debit the buying company, credit realization account. Then once this company gives me the purchase consideration, I will record equity shares, debentures, cash respectively. What will I do this? This I will give to the equity shareholders here. This I will give to the equity shareholders here. By doing this entire activity, all your respective accounts gets closed, and the realization account profit or loss is transferred to equity shareholders account. Okay, if it is a profit, you will credit the shareholders. If it is a loss, you will debit the shareholders, right? Then once you pass all the entries, equity shareholders account will be 0. Most important from the examination point of view is the entries in the books of the transferee company. Transferee company means the buying company. What is the buying company getting? The buying company is getting assets. The buying company is taking over some liabilities. The buying company is issuing some purchase consideration. The buying company may incur some expenses. All of that has to be incorporated. How do we do that? We will debit all the assets. We will credit all the liabilities, and we will credit reserves if it is pooling of interest method. Okay, so first you will incorporate assets, liabilities and reserves taken over from the transferring company, debit all the assets, credit all the liabilities, P&L reserves to business purchase account. This is if it is in the amalgamation in the nature of merger. A business purchase account is an account maintained to keep a track of purchase consideration. So when we have the amalgamation, you will debit business purchase account with the amount of consideration to liquidator of transferor company. Sir, why liquidator of transferor company? Because the transferor company, the liquidator has transferred, or the liquidator has issued or will issue the shares to me. The liquidator will give me money, so I am crediting liquidator. So business purchase to liquidator, incorporate all the assets one by one, don't pass a bulk entry, one by one, and because it is purchase method, interest method, book value only with book value, and credit the business purchase account with the consideration. So basically, if you see, this business purchase account and this business purchase account gets knocked off. Okay. Then whenever we are issuing shares or giving cash to the selling company, we will debit liquidator. Here we have credited, we will debit liquidator and issue those shares. So when we pay the consideration, liquidator of transferor company to equity, share capital, preference, share premium, bank account. So all of this is then bank only fractional shares. If liquidation expense of transferor company are borne by the transferee, if I am the buyer and if I have to bear the liquidation expenses of the transferor company, then I will reduce it from the reserve. Okay. Then if there is any new company which is being formed, will debit preliminary expenses, that is okay. And discharge of liability, if I have discharged subsequently, for example debentures, I will debit debentures and credit the new debentures. Pooling of interest method. Now the next thing is purchase method. In case of purchase method, the thing that gets different is here we had all book values, here we will not have book values. Okay. So first entry remains the same. Second entry, sundry assets to liabilities to business purchase at revalued figures or book values. If new number is given, if new value is given, new value, otherwise old value. If new value is given, new value, otherwise old value. Okay. Then if net asset and purchase consideration, if purchase consideration is more than the net asset, there is goodwill. That goodwill also will be accounted here. Apart from sundry assets, you will have goodwill. Or if you pay the lesser amount, you will have capital reserve. So debit goodwill, debit assets, credit liability, credit business purchase, credit capital reserve if there is a thing. So either goodwill or capital reserve. Will we take any reserves of the transferee company or the transferor company? No, we will not take. In the pooling of interest method, we took it. In this method, we will not take. Right? Then, when you issue or when you make the consideration, same entries like we have done earlier. If there is any statutory reserve, amalgamation adjustment to statutory reserve, we will pay. If liquidation expenses are borne, then goodwill to bank. In the pooling of interest method, we have debited this to reserves. Here, goodwill to bank. Sir, if there is no goodwill, then capital reserve to bank. If any liability is discharged, this is the entry. Simple. Okay. Now, two important aspects. Number one is intercompany owings and the second one is stock related adjustment. If for example, A Limited purchased B Limited. In A Limited balance sheet, you have account receivable B Limited 1000. In B Limited balance sheet, you have account payable A Limited 1000. Now, after the business has combined, after you have combined the business after the amalgamation, is there a need to pay or receive? There is no need to pay or receive. So, what you will do? You will offset these two after the amalgamation. A lot of students, what they think is, this should not be taken over. No, you will take over all the liabilities and after the amalgamation, you will knock off the liabilities. Please keep that in mind. Okay. So, if there are any intercompany owings, you will cancel them off after the amalgamation is completed. Then, if there are any stock related adjustment means what? Let us say A Limited sold inventory to B Limited. For A Limited, the cost is 1000. Sold to B Limited, selling price at 1200. Now, I bought the business itself. A Limited acquired B Limited itself. Now, what is our inventory valuation principle? Lower of cost on net realizable value. When my cost is 1000, in the combined entity, I cannot show it at 1200. So, what will I do? I will reduce the inventory value. I will reduce the inventory value by 200. So, I will credit 200. And where should I adjust? Either goodwill or capital reserve. I will do the adjustment. Right? These are the things you have to keep in mind. Most important part is these set of entries. If you tend to forget or if you keep on forgetting, please revise, because by passing this entry, each entry will give you 1 mark in the examination. Each entry will give you 1 mark in the examination, and by passing this set of 5-6 entries, you will be able to score the 6 to 8 marks. Now what we'll do is, we'll not have a break right now. We'll have a break after we complete a couple of questions, including a past examination question which was asked in May 24. That will ensure, or that will show that yes, we are able to handle amalgamation related questions in the examination. Okay. For your practice, after the class, you can complete this 8th problem, super express and fast express. We'll have a look at question number 12, and we will have a look at the next question after that, and then the past exam question. Okay. I hope the session is useful to you. You are able to revise these concepts very quickly, and I'm sure after the session gets over, you'll have more confidence to handle the examination question. Now, in the subsequent questions, I'll tell you how will the examiner mark, how will you get marks in the examination. I will show it to you, I'll demonstrate it to you. And one good thing for all of you is, I don't know, unless the institute changes the pattern, you have a 14-mark question. So in 14-mark question, they cannot add too many complexities. Okay, they can add 1 or 2 critical adjustment. Earlier, we used to get very long adjustments. Now we do not have such kind of adjustments, right? Draft balance sheet as on 31st March of best and better is given below. As I told you, no need to worry about this assets balance sheets for now. Better Limited issued bonus shares on 1st of April in the ratio of 1 share for every 2 shares held out of reserves and surplus. So who is better? This is better. Okay, what they are saying, for every 2 shares. So right now, if you have 10, okay, this should be rupees in lakhs or something. 10, you have face value of 100. For every 2 shares, you will issue 1 more share. So basically, you will issue shares for 5. Okay. It was agreed that on which date? 1st of April. This balance sheet is on which date? On 31st of March. Okay, so that is after the balance sheet date. It was agreed that Best Limited will take over the business of Better Limited on the basis of the latest balance sheet, consideration taking form of allotment of shares in Best Limited. So we'll give shares. The value of shares in Best Limited was considered to be 150, and the shares in Better Limited were valued at 100 after the issue of bonus shares. The allotment of shares is to be made on the basis of these values. So on the basis of these values of shares, you have to make. Liabilities of Better Limited include 1 lakh due to Best Limited for purchases from it, on which Best Limited made profit of 25%. The goods of 50,000 out of the said purchases remained in the stock on the date of above balance sheet. Now, what does this mean? There are 2 adjustments here. One, there is an intercompany liability. Okay, that we have to set off. Second, 50,000 is still lying in stock. Now, in this 50,000, I have a 25% of profit, and that 25% of profit I have to eliminate. A lot of students have this problem in calculating the profit. So I'll just give you, they try to mug up. No, I've seen a lot of students, if it is 25%, then it has to be 33%. If it is 20%, then it has to be 25%. Don't mug up. Okay, don't mug up. Don't be a dummy. Don't mug up. Find the logic. They have given 25% of cost is the profit. Whatever this profit percentage is given on, assume that as 100. If cost is 100, profit is 25, selling price is 125. Now, the selling price of 125 is represented by 50,000 of stock. What is the profit element? Do a simple cross multiplication. So that will be 50,000 multiplied by 25 divided by 125. So you can calculate. If it is given 25% on selling price, then you will take selling price as 100, profit as 25, cost will be 75. Okay, so if the selling price is 50,000, how much is the profit? 50,000 into 25 divided by 100, you can calculate. Okay, so don't say that, sir, if it is 25% on cost, it has to be, let us say, 33% on the selling price and all of those things. That is not the right way. Okay, that is not the right way to understand ratios. You have to know what is the underlying logic. So on this, you have to calculate what is the unrealized profit, and that has to be eliminated. Make the closing ledger in the books of Better Limited and the opening journal entries in the books of Best Limited, and prepare the balance sheet as at 1st of April of 21 after takeover. So now, what I have to understand first. So just a moment. This is in lakhs. Okay, this is rupees in lakhs. I think it got hidden down. That is rupees in lakhs. Now, what did Better Limited do? Better Limited first issued a bonus share. So, you have 10 lakhs divided by 100. That is, it will give you the number of shares into 1 by 2. 1 by 2 means 1 bonus share for every 2 shares held. So, this 0 goes off. You have 1 lakh. 1 lakh divided by 2. You have 50,000 new shares. So, you have existing shares here 10,000 and you have 5,000. Sorry, you have existing share 10 lakhs divided by 100, 1 lakh, and you have new shares 50,000. So what is the total number of shares? 1,50,000. Anything you pay to the shareholders, that is 1,50,000 shares, that becomes your purchase consideration. Now what did we pay? Value of shares in Best Limited was considered to be 150 and the shares in Better Limited were valued at 100. So the total shares, if you see here, you have 15 lakhs. 15 lakhs divided by 100. 15 lakhs divided by 100. How many shares do we have? We have 1,50,000. To satisfy those 1,50,000, we will issue shares in the new entity. What is the new entity? The acquiring entity, Best. At what valuation? We will issue them at a valuation of 150. So basically what they're saying is, this 15 lakhs, you give shares worth 150 each. So how many shares are issued? 15 lakhs divided by 150, 10,000 shares are issued of 150. 10,000 shares of 150 becomes the purchase consideration, which is 15 lakhs. That is the first thing. So first step you will do, always calculate the purchase consideration. Paid to whom? Equity shareholders. In what form? Equity shares from Best. How many shares we have? 15,000. What is the worth? 15 lakhs. How many shares will we issue? 10,000. The total purchase consideration is 15 lakhs. I hope this is clear. Right? Then, this we have already calculated, number of shares after the bonus issue. Then what they have said? They have said in the question, the requirement, make the closing ledger in the books of Better Limited. So, I am just erasing this. It's become too much of a mess while explaining. Make closing ledger in the book of whom? In the books of Better Limited. So, in the Better Limited, closing ledger means what? Realization account. When it comes to realization account, what is it? You will transfer all the assets and you will transfer all the liabilities. So, in the realization account, here, what you will do? Take all the assets, 15 lakhs, there is no investment up, and current assets 5 lakhs, all the liabilities 2 lakhs. So, you see 15 lakhs, 5 lakhs, 2 lakhs. Now, sometimes in the examination, they will ask you to pass journal entries. Can we pass the journal entries? Realization account debit to fixed asset to current asset. Liabilities account debit to realization account. It's very simple. Okay. Then, whatever is the purchase consideration from Best Limited, this is my PC. PC has to come here. So, 15 lakhs plus 5 lakhs, 20 lakhs minus 2 lakhs. How much? 18 lakhs. And we received 15 lakhs. So, there is a loss. Loss of 3 lakhs. This loss has to be transferred to equity shareholders. So, you will see, in partners capital account, if you remember, you used to do by share capital, by partners share capital or by partners account. Same way here, by equity shareholders, 3 lakhs. Now, while preparing ledgers, one thing that I want all of you to do so that you don't miss out anything is that you have to prepare realization. Yes. You have to prepare equity shareholders account. Yes. Simultaneously, after realization, have equity shareholders account prepared. So, equity shareholders account, what all will we get? We will get share capital, 15 lakhs. Sir, how is it 15 lakhs? Here they have given only 10 lakhs. 10 lakhs is the original capital. 5 lakhs is the bonus issue. That makes it 15 lakhs. Okay. But, this reserves of 8 lakhs, we have used 5 lakhs to issue bonus shares. So, this is now only 3 lakhs. So, in the reserves, what you bring forward will be only 3 lakhs. Then here you posted loss. A lot of students, they miss out. So, immediately this 3 lakhs, you put it here so that you don't miss out. Okay. Then, Best Limited also we can prepare the ledger. Best Limited to realization 15 lakhs by equity shares in Yes Limited 15 lakhs. This 15 lakhs, whatever equity shares you get, that you will transfer to the equity shareholders account 15 lakhs. So, this account gets tallied, the realization account is also closed. Then, Opening journal entries in the books of Best Limited. Now what is Best Limited doing? Best Limited is acquiring all the assets. Now have they changed the value of assets in the question? They have not changed. So what will do? You will take first entry for purchase consideration. First entry for purchase consideration. Business purchase to liquidators 15 lakhs, 15 lakhs. Then incorporating the assets 15 lakhs, 5 lakhs. Fixed asset, current asset. Liabilities 2 lakhs. Business purchase 15 lakhs. The balancing figure 3 lakhs is the capital reserve. Now if you just compare this, here you got capital reserve. For these entities you got loss. Okay. So how do we get capital reserve? Net asset, fixed asset plus current asset 20 lakhs. 20 lakhs minus 2 lakhs 18 lakhs. We paid only 15 lakhs. So 3 lakhs is the capital reserve. Right? Then you have to issue shares to the liquidators of Better Limited. So you will debit liquidators of Better Limited to equity shares to securities premium. 100 face value, 50 securities premium. Right? Then there is an intercompany owing of how much? 1 lakh. So you have to cancel that out. What will you do? The payables you will debit, the receivables you will credit 1 lakh, 1 lakh. Then there is unrealized profit. How much is the unrealized profit? We've calculated here. 50,000 into 25 by 125. So 25 5 10,000. This you will adjust. Now this 10,000 you will reduce from the stock and you will add it back to the, or you will debit it to the capital reserve. So stock 10,000. This can be P&L or capital reserve. P&L is more conservative approach. You can debit it to capital reserve as well. Now, after you have passed all of these entries, the thing that you have to keep in mind, or the thing you have to keep in mind while preparing the combined balance sheet is very, very simple. Very, very simple. What you have to do? Take assets, add. So 25 plus 15, 40. Investments 5, 0, 5. Current assets 20 plus 5, 25. But then also look at the journal entries and see where all you have made the adjustments. What are the adjustments you have done? You have reduced 1 from trade payables. And you have also made an adjustment of 10,000, 0.1 in inventory. Same way in the liabilities, share capital, you will have 20 of best plus fresh 10 lakhs of share issue. Reserves and surplus 10 plus securities premium of 5 plus what you have done? Your 3 lakhs of capital reserve minus 0.1 of loss. Other liabilities 20 minus 1. So like that, 20 plus 2 minus 1. Like that, line by line item if you add, you can prepare the combined balance sheet. Line by line item if you add, you can prepare the combined balance sheet. Only that thing you have to do. No need to break your head. Just take line by line, add them and present in the answer. So if you see fixed assets 40, okay, then non-current investment 5 as it is. Current assets 2390. How did they get? 2390, how did we get? 25 minus 1, 24, 24 minus 0.1. This one is for trade receivable, this is for inventory. So what you have to keep in mind is, where students make a mistake in the exam is, they don't adjust, this has to be adjusted, this and this. If you adjust this in the balance sheet numbers, then it will be done. Okay. 2390. Then comes to share capital, 20 plus 10. Reserves and surplus, again 10 plus 3, not 8, sorry. 10. So this will not come anyway, sorry. 10, then 5 of securities premium, 15, plus 3 of capital reserve, 18, minus 0.1, 17.9. So you have 7.9, 17.9. Okay, so here it is a brought for bringing forward error. Okay, then current liabilities 21 we have calculated. So by doing this and by preparing these notes to accounts, you can score full marks. Now how is the marking done? I'll tell you. Okay, how is the marking done for the examination? This normally will carry 2 marks. This will carry 1 mark. This 1, 2, 3, 4, 5 entries, 2 marks. Equity shareholders, 1 mark. Journal entry here, 1 mark, 2 marks. This is 1 mark. This is 1 mark. This is 1 mark. Balance sheet, 1, 2, 3, 4, 5, 6, 3 marks. Notes, 4 notes, 4 marks. So 4 plus 3, 7, plus 1, 8, 9, 10, plus 2, 12, 13, 14, 15, 16, 17, 18, 19. So roughly around 16 to 18 marks is this question worth. Now because you get only 14 marks in the examination, they may not ask you this realization account and equity shareholders account, and they may ask you remaining thing. Now, a lot of students, the mistake that they do, and I want all of you to pay utmost attention, is if there is a difficult adjustment, they will leave everything. Please don't do that. Can we pass this entry? Can we pass this entry? Can we do these small entries? Then can we prepare this balance sheet? At least add the numbers which you can add directly. Can we prepare these notes to accounts? All the marks is there. You will not lose marks. Even let us say you make a mistake in purchase consideration. Just a scenario. Okay, all of you, please note this point in your mind. Assume for a moment I made a mistake in purchase consideration, and it is possible. Okay, I made a mistake in purchase consideration. Then what will happen is, let us say you got a 14 marks question and you made a mistake in purchase consideration, 100% mistake. So you will not get 2 marks here, -2. Okay, then because your purchase consideration is wrong, this entry will be wrong. Okay, then here out of these 2 marks you will get 1 mark. Here you may not get marks. This 1 mark you will get, this 1 mark you will get. So 1, 2, 3 marks is there. In the balance sheet, share capital may be wrong, this may be wrong, but this assets, tangible assets, non-current assets. So out of 3 marks you will get 2 marks here. So 2, 3, 4, 5. Notes to account, these 2 may be wrong, these 2 will be there. So 2, 5 plus 2, 7 marks here, and this working note, 1 more mark. So 8 marks. Out of 14 marks, even after making a mistake in the purchase consideration, you will be able to get 7 to 8 marks. Now tell me, if you can get 8 marks here, 8 marks in consolidation, 16 marks is there. Target 20 marks in MCQ, 36 marks is there. Then you have remaining 40-45 marks of question paper to take care of your passing requirement and your exemption. The problem what happens is in the examination, and I have also as a student gone through it, we get too tensed when we see an amalgamation question. I remember in my CA final, I had to do this amalgamation question. It was an intercompany question. There was an intercompany holding question. I had to do it twice. First time I made a silly mistake. Thankfully I checked it. I had to do it twice, and still I had some time. That was a different thing. But if you follow these basic principles in mind, how to prepare this combined balance sheet? Can we not prepare combined balance sheet just adding 2 balance sheets? Right? Can we not do that? We can definitely do it. Right? Can we not make notes to accounts? A lot of students, they don't make these notes to account. I'll tell you, this carries marks. If you don't prepare notes to accounts, you will lose marks in the examination. So please don't ignore. A lot of students, they'll do this. They will not do this, and then they come saying, sir, I did everything right. Out of 14, I got only 10. Because you have not done this. Do this, get that bonus marks. Okay, so that is the whole thing. Then next one, this one more question, I found it very, so many adjustments. Comprehensive question, I call it. Sir, will we get 7-8 adjustments in the examination? You will not get, because now they can test only for 14 marks. They cannot test you for 20 marks. They will test you only for 14 marks. 14 marks means 8 adjustments not possible. Okay. Yeah. K Limited and L Limited amalgamate to form a new company, LK Limited. Now here, K is not buying L, L is not buying K. You have a new entity altogether, LK Limited, which is buying both this entity. The financial position of these two companies on the date of amalgamation was as below. Share capital, 8 lakhs, 3 lakhs. Preference shares, debentures, general reserve, profit and loss account, trade payables, secured loans. Then you have goodwill, land and building, plant and machinery, furniture, trade, stores in inventory, cash in bank, cash in hand. All the information is given. The following is the scheme of amalgamation. The assumption of liabilities of both the companies by new company. Issue of 5 preference shares of 20 each in LK at 18 paid up at a premium of 4 per share for each preference share held in both the companies. So, whatever is the number of preference shares here, you will issue 5 preference shares for each preference share. So if I have 4 lakhs divided by 100, if I have 4,000 into 5, 20,000 shares will be issued. At what value? 18 paid up and a premium of 4. Issue of 6 equity shares of rupees 20 each at 18 paid up and a premium of 4 for each equity share held in both the companies. So now here, how have they given the purchase consideration? They have said to equity shareholders, we will give 6 equity shares at what value? 20 and 4, 18 and 4 premium. Okay. Then, so when you say 18 and 4, 18 is paid up value and 4 is the premium amount. Same way for preference shareholders, 18 paid up and premium of 4. Okay. In addition, necessary cash should be paid to equity shareholders of both the companies as it is required to adjust the rights of shareholders of both the companies in accordance with the intrinsic value of the shares. Okay. Apart from this purchase consideration, pay some more cash so that the respective value of the companies is adjusted based on the intrinsic value. Means what? We need to calculate the intrinsic value in this question. Okay, this is a slightly complicated question and mark it as important. I am doing this. Mark it also as important from examination point of view. Not that the same question may come, but some of the adjustments from here may be picked up and be given as a new question. Issue of such amount of fully paid 6% debentures in LK Limited as is sufficient to discharge the 5% debentures in K Limited at a discount of 5%. Now this, does it form a part of a purchase consideration? No. But I have to discharge at a 5% discount. So I have to do the computation for that as well. How many debentures should I issue? That working note also you have to prepare. Assets and liabilities are to be taken at book values except for inventories and trade receivables for which a provision of 2% and 2.5% respectively to be raised. Now, the moment you adjust the value of assets and liabilities, is it amalgamation in the nature of merger? No, it is an amalgamation in the nature of, purchase. Also one more thing, here cash is being paid. So again, there also it is not an amalgamation in the nature of merger. The trade receivable include 20,000 due from L Limited. So K Limited and L Limited, there is an intercompany balance. LK Limited to issue 15,000 new equity shares of 20 each, 18 paid up, premium of 4 shares so as to have sufficient working capital. Prepare ledger accounts in the books of K Limited and L Limited to close their books. Okay. Now, here, what they are doing, they are saying that LK Limited will subsequently issue new shares. Is this a part of my purchase consideration? This is not a part of my purchase consideration. After the amalgamation, subsequently is when they have issued this. Right. Now, what they have asked us to do is you have to prepare books to close the ledger accounts of K Limited and L Limited. Now, before that, what we need to do, we need to prepare the working notes to calculate the purchase consideration. Right. Now, what is the purchase consideration? But how do you calculate purchase consideration? Total purchase consideration. And before that, we also need to have a look at the net asset value. Now, net asset value, if you see, we have goodwill, land, buildings, plant and machinery, furniture and fittings. Now, this trade receivable needs an adjustment. What is the adjustment? Oops, I think I've missed it in the solution here. I'll just do the calculation. So I don't know how we miss the working notes. Sorry for that. When it comes to net assets, so let us take one by one from the question of each of the entity. You have goodwill, you have land and buildings, 450 will take as it is, plant and machinery as it is, furniture and fixtures as it is, trade receivable 2,75,000. Now on this trade receivable, what they have said is there is a provision required, inventory 2%, trade receivable 2.5%. So now 2,75,000 into, see, 2.5% is my provision. So I have to take 97.5% value. So if I take 97.5% value, I get 2,75,000 into 97.5, I get 268,125. 268,125. Same way I'll calculate for this. Then inventory 220,500. How do we get that? Inventory 225,000. You will reduce 2%. So if I do 225 into 98%, 22,500. Same way you can calculate for this. Then you have cash at bank and cash in hand. That is what is given, right? Yeah. So that gives me the total on the asset side. Then on the liability side, you have debentures, trade receivables, debentures, trade receivables, not trade receivables, this is trade payables. Trade payables and loan. So trade payables, loans and debentures, these are the liabilities. Now once we do that, what happens is we get the net assets for all the shareholders. This is very important. This is the net assets for all the shareholders. Now if I come back to the balance sheet, here I can see I not only have the equity shareholders, I also have the preference shareholders. Now tell me one thing, this assets that belongs to us, that also belongs to the preference shareholders, not only to the equity shareholders, right? So what we have to do is, from whatever purchase consideration we get or from whatever net assets we get, how much we will give to the preference shareholders, that we should keep aside, and the balance is what is attributable to the equity shareholders. Okay, so you will settle the preference shareholders in the form of preference shares of LK Limited by paying them 4,40,000 and 3,30,000. How do we get that? Now that they have given to us in the question. They have said issue 5 preference shares of 20 each in LK at 18 paid up 4 per share and premium of 4 for each preference share held in both the companies. Meaning to say, if I have, let us say for this company, I have 4,000 shares, preference shares. How much should I pay them from the net assets that I have? 4,000 into 18 plus 4, 22. 18 plus 4, 22 into 5. Why 5? Because 5 shares are being issued. So 4,000 into 5 into 22, if I do 4,000 into 5 into 22, if I do into 22, if I do, I get 4,40,000. So from the net assets, what I am saying is 4,40,000 is what belongs to the preference shareholders from the net assets, and the balance belongs to equity shareholders. So 4,40,000 belongs to preference shareholders and balance belongs to equity shareholders. So 4,40,000 to preference shareholders. Same thing you can repeat for the other company. Then equity shareholders, how are we settling? So 1560 minus 540. 1560 minus 440, what is left is 0,211. 1120 is what is left. Now for 1120 of the net asset that is left, what we are required to give? Equity shares and balance cash. How much is the equity shares? Again here, 6 equity shares of 20 each at 18 paid up and a premium of 4 for each equity share held in both the companies. So 6 shares. How many shares are there? Share capital 8 lakhs. So 8 lakhs means 8,000, right? 8,000 into 6 shares into 22 only, right? 18 plus 4, 22. So 8 lakhs into 6 into 22, that is what will be paid. 8 lakhs into 6 into 22, 10 lakh 56,000. Now, this thing what you have to understand is, out of 1560, I have to give 442 preference shareholders. I have to give 1122 equity shareholders. How much am I giving by shares? Only 1056. So balance they are saying give by cash. How much? 64,000. Same thing you can repeat for the other entity. Now, how do we close the books of account in each of the books? In the books of K Limited, take all the assets at book value. This take it at book value only. Okay. Then from this book value, take all the liabilities. What is the purchase consideration? It comes from there. Now, whenever there is a preference shareholder, first we have to see what is the gain or loss on account of preference shareholder. So, preference shareholders, if you see, their share capital is 4 lakhs only, but we have to pay them 4,40,000 out of whatever we received. Out of whatever we received, we have to pay them 4,40,000. Means what? We are giving them 40,000 extra. So, the equity shareholders will say we are at a loss. So, that loss is 40,000. This loss you will transfer to realization account. Whatever extra payment, so this is a very important point. Any excess payment to preference shareholders is a loss. Then after all of this, you will find what is the balancing figure. This is the loss to equity shareholders. Right? Now that equity shareholders loss, you will transfer to equity shareholders account. Then whatever shares and cash you receive, you will transfer here. Share capital and one more thing. Whatever is there in the balance sheet, general reserve, P&L balance, right? The equity share capital balance, all of these have to be transferred to equity shareholders account. So you will transfer these to equity shareholders account. Whatever is the number given, you will transfer that to equity shareholders account. Okay. So in the equity shareholders account, you will see share capital, P&L. For the other entity, you will also see reserves. Then against this, any loss on realization, equity shares received from the other entity and cash received from the other entity. Okay. So that is how you will do the closure of the books. Now, how will we prepare the combined balance sheet of the new entity? Very simple. Take respective assets, whatever you have calculated here, net assets, right? Take these assets, just keep summing all the assets, sum up all the liabilities, right? Then you will see whether there is any goodwill or capital reserve. Now, in this case, if you see carefully, the total net assets is equal to the total consideration. So, there will not be any goodwill or capital reserve. Okay. So, just add up the numbers, issue of shares, security premium, your balance sheet is done. Okay. Now, what we will see is an actual examination question for May 24 and figure out, are we prepared to handle these kind of questions and what is the breakup of that 14 marks? That is what I will be discussing with you. And after this question, we'll have a break for about 15 minutes and then we will continue. And we'll continue with consolidation. Okay. So look at this question, question number 4. This has been tested for 14 marks. Intelligent Limited and Diligent Limited are carrying their business independently for the last 2 years. Following financial information in respect of both the companies on 31st March has been given to you. Intelligent Limited, Diligent Limited. Equity shares, preference shares, trade payables, retirement gratuity fund, P&L account, opening balance, profit for the current year, land and, so this is P&L balance. Then you have land and buildings, plant and machinery, inventories, trade receivable, cash and bank. On 1st of April, both the companies agreed to amalgamate and form a new company, Genius Limited. So Intelligent, Diligent, Genius. With an authorized capital of 40 lakhs divided into 30,000 equity shares of 100 each and 10,000 8% preference shares of 100 each. The amalgamation has to be carried out on the basis of following agreement. Assets have to be revalued, 11 lakhs, 8 lakh 50, 9 lakhs, 4 lakhs. So you can see these numbers, 6 lakhs, 3 lakhs. So for the combined entity, this is the relevant value. For remaining assets and liabilities, book values are relevant. Trade payable of Intelligent Limited includes 1 lakh due to Diligent Limited and trade receivable of Diligent shows 1 lakh receivables from Intelligent Limited. So after the acquisition, you can do the net off. Purchase consideration to be discharged in the following manner. 22,000 equity shares of 100 each, fully paid up in the proportion of sum of their profitability in the preceding 2 financial years. So now here, what they have said is, here they are not saying on the basis of net assets, on the basis of their profitability. Preference shareholders of both the companies are issued equivalent number of 8% preference shares of 100 each at a price of 125. So you'll give the preference shareholders 8% of 100 each at a price of 125. So 125 becomes the relevant purchase consideration. 12% debentures of 100 each in Genius Limited at par to provide an income equivalent to 10% return on the basis of net assets in their respective business as on 1st of April of 24 after revaluation of asset. Now what is this? This is purchase consideration, and in purchase consideration they are saying we will also give 12% debentures which will give us 10% return on the basis of net assets in their respective business as on 1st of April after revaluation of asset. So slightly tricky in terms of this third point. Now, what does the third point say? We will give them 12% debentures so that they can earn 10% on net assets in their respective business as on 1st of April after revaluation. So calculate the net asset after revaluation, consider 10% return, to give them the 10% return, issue them 12% debentures. Okay. Now, compute the amount of shares and debentures to be issued to Intelligent Limited and Diligent Limited. Prepare a balance sheet of Genius Limited showing the position immediately after the amalgamation. This is a 14 marks question, and that is what we have to see, right? Now, and this information, whatever information you see, this information is as on 31st of March. Yeah. So we'll issue 22,000 fully paid in the proportion of the sum of their profitability in the preceding two financial years. Now we do not know from which period is this number given. Oh, they have given last 2 years. So you have 4,50,000 plus 2,50,000, 7 lakhs is Intelligent Limited, 2,50,000 plus 1,50,000, 4 lakhs is your Diligent Limited. So the total purchase consideration here that they are saying is 22,000 into 100, that is 22,000. This you split in the ratio of their profitability, 700,000, 7 lakhs and 4 lakhs. Means what? 22 lakhs you split in the ratio of 7:4. 22 lakhs you split in the ratio of 7:4. So the total 22,000 that you will issue, total 22,000 shares that you will issue, 7 out of 11 will go to Intelligent Limited and 4 out of 11 will go to Diligent Limited. So purchase consideration in form of equity shares to Intelligent Limited is 22,000 into 100 into 7 out of 11. So how did we get 7? Sum of profitability of 2 years, 7 and 4. Okay, so when you do 7:4, 7 out of 11 and 4 out of 11. So 14 lakhs here, 8 lakhs here. Okay. Then preference shares are issued equivalent number of 8% preference shares of 100 each at a price of 125. This means preference shares of 100 each, if you see, we have 3,000. We will issue 3,000 shares, but the valuation is 125. Here, we will issue 2,000 shares, valuation is 125. So, 3,000 into 125 and 2,000 into 125, 375 and 250. Then, for debentures, we have to calculate the net assets, and using that net assets, we have to calculate how much debentures have to be issued. So, let us see the net assets. Yeah. So, net assets, we have to consider assets after revaluation. So, if you come back to the question, 11 lakh, 9 lakh, 6 lakh, 850, 400, 300. So, that is the revalued number you have to take. So, the number that you will take is 11 lakh, 9 lakh, 6 lakh, 850, 4 lakh, 3 lakhs. Then trade receivables 6 lakhs, 3 lakhs, 4 lakhs, 1 lakh. Trade receivables 6 lakhs and 3 lakhs. Now there is an intercompany owing. Should I adjust that? See, even if you adjust that, this will go off from trade receivable, will go off from trade payable. Ultimately, the net amount will be the same. So it will not be different. Okay, both the assumptions are allowed. Then trade payables, gratuity fund. Now gratuity fund is payable to the employees. That fund is created. It's not a reserve fund. It is a fund created to pay gratuity. So that is a liability. Okay, don't think it's not a reserve fund. It is a fund for the employees. You would have learned about this in AS 15 as well. right? 3 lakhs, 2 lakhs and 4 lakhs. So you get net assets of 21 lakhs and 13 lakhs 50,000. Now, what they're saying is, on these 21 lakhs, I need to give them 10% return. I need to give them 10% return. So 10% return is 2 lakhs 10,000. I have to give them 2 lakhs 10,000. Now, what is my debenture return? My debentures will give a return of 12%. So I have to give them a return of 2 lakh 10,000 totally. Okay. Now, if I need to give them a return of 2 lakh 10,000 and my debenture gives a return of 12%, so how much should I issue? Simply you can divide 2 lakh 10,000 divided by 12%. If I do, that is 0.12. If I do, I get 17 lakh 50,000. So what it means is, if I give them debentures of 17 lakh 50,000, on this 17 lakh 50,000 they will earn 12% return and they'll get 2 lakh 10,000 of income. Now valued at 100, so if I divide by 100 I get 17,500. So 17,500 share debentures here, 11,250 debentures here. Now one thing you have to keep in mind is, even if I am issuing debentures to equity shareholders or preference shareholders, they are a part of the purchase consideration. Don't think that because I am issuing debentures it is not purchase consideration. Don't do that mistake. Again, this part, and again repeating, and sometimes what they also say is 10% debenture holders will be given 12% debentures so that their income is not lost. That time also you have to calculate in the same way. What we are saying is 21 lakhs is the total net asset. I need an income of 2 lakh 10,000. I need an income of 2 lakh 10,000, which is 10%. But my debentures gives a return of 12%. So how much should I issue? 2 lakh 10,000 divided by 12%. So the number that comes is 17 lakh 50,000. Number of debentures is 17,500. Same thing for diligent. So your purchase consideration, you will put 17 lakhs 50,000. So the total purchase consideration comes to 3525 and 2175. This is the total purchase consideration. Now we have calculated net assets. Net assets is 21 lakhs and 30 lakh 50,000. Now based on that, you take the purchase consideration less net assets, you will get the goodwill. Okay. Now, how to prepare the combined balance sheet? Very simple. Take these net assets as them. Add 11 lakhs, 9 lakhs plus 4, 6 lakhs plus 3, 6 lakhs plus 3 minus 1 lakh. Sir, why minus 1 lakh? There is an intercompany owing. Then 4 lakhs plus 1 lakh. Then trade payables 12 plus 4 minus 1 lakh. Gratuity fund 3 plus 2. That becomes your liability. So in the combined balance sheet, you can see land and buildings 7 lakhs plus 850, plant and machinery 9 lakhs plus 4 13. So 11 plus 9 20, 20 plus 12 32 5. So 3250. The number that you can see here is 3250. For this you need to have a note. Same way intangible assets, goodwill that you have calculated. Okay. Inventories 9 lakhs, trade receivable 6 plus 3 minus 1 8 lakhs, cash and cash equivalents as it is taken over. Trade payables total. Then your gratuity fund comes here. Long term borrowings, add very carefully, add debentures that has been taken. Okay. Then when you issue shares, you have share capital. This is at face value. In the reserves and surplus, you will have the securities premium, if at all there is. Share capital authorized, you have preference share capital 10 lakhs authorized, then issued 22 lakhs and 5 lakhs, and you have securities premium 1,25,000. So how to get securities premium 1,25,000? Those securities premium of 4 rupees on preference shares and equity shares. That is what is here. Okay. Now, if you see this thing, this will come for 2 marks. Balance sheet 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So this will be about 4 marks. 6, 1 mark, 7, 8, 9. These two put together 9. Then this put together maybe another 2, 11 plus 1, 12 plus 2 maybe 14. So I'm over. So this is slightly lengthy question. 14 then this would be 115, this would be 116. So what they would do most likely is from this notes they'll cut off 1 mark here, and instead of balance sheet they'll have some 3 marks here for the balance sheet. Okay, now the point that I'm trying to make you make here is, if you are able to prepare the balance sheet, prepare these notes, and do this calculation of net assets properly, you will be able to score 10 to 12 marks easily in this question. It may take, now one more thing, this is a 14 mark question. Within 30 minutes, if you are not able to solve it, then don't waste any further time. In the examination, a lot of students, what they do is, I know the answer, I've done half the question, I'm not able to solve it. More than 30 minutes, you should not take. Now, what you can do after the session gets over, tomorrow, day after, whenever it is, try to solve this on your own and put a timer and see, are you able to finish it up in 30 minutes? Okay. If you are able to finish it up in 30 minutes, very good. Now, one more doubt what students have is, sir, why did we not give notes for inventories, trade receivables, cash and cash? Because these are straightforward numbers. Inventory is a straight number. Trade receivable is a straight number. Cash and cash equivalent is a straight number. PPE is not a straight number. PPE, the breakup is given as different assets. Plant and machinery, land and building. So then you have to do that adjustment. Okay. So I hope, I just want a quick response from all of you who are right now live. I hope the revision so far has been helpful. You are able to quickly recap all the concepts that are required for your amalgamation preparation. If yes, please put it in the chat box. That will encourage me or motivate me. Been talking non-stop for the last 2 hours now. And also do like the videos, share the video and subscribe to the channel. What we will do, we will get back after 10 minutes. It's 11:55 now. So we'll reassemble back at 12:55 and continue with the next topic, that is consolidation. So there is a break. We'll resume at 12:05. Guys, I need some motivation from your side by a comment, so that I feel that yes, this session has been useful to all of you. Yeah. Okay, so the team is suggesting that we should give a slightly longer break. So we'll reassemble back at 12:10. In the meanwhile, I'll also have something to keep myself energized. So break. We will resume at 12:10. And from 12:10, the next break will be at around 1:30 for lunch, about 45 minutes of break, and then we'll continue after that. Yeah, sure. Thank you. So, welcome back. I hope I am audible now because I had put it on mute, and if the volume is low, please let me know. I'll increase the volume for now. Okay, if it is too high, please reduce the volume of your device. I hope it is clear. Thanks everyone, thanks for the wishes. So after completing amalgamation, we'll move to consolidation, which is to do with the consolidated financial statements. Now, small thing, I hope all of you are back now. My audio video is clear and visible. One small thing, a small relationship between amalgamation and consolidation, which I want all of you to be aware of. Okay. Which I want all of you to be aware of. Okay, and this will help you in real life also, just by the time others also join in. When we say amalgamation, we said A Limited purchased B Limited. When we say consolidation also, we say A Limited, let us say, purchased 80% of shares of B Limited. Or sometimes it can be 100% also. It is not that you will have consolidation only when there is 80%. Their consolidation happens also when there is 100%. Now, what is the difference between these two? Why are we saying, AS 14, when do we apply? AS 21, when do we apply? That confusion, you get it cleared in your mind, is that when A Limited purchases B Limited, and if A Limited is taking over, absorbing the business, and B Limited no longer continues to exist, then you will follow AS 14 accounting. But if A Limited purchased, let us say 100% shares of B Limited, but A Limited is functioning independently, B Limited is also functioning independently, then we do something called as consolidation. We combine the balance sheet of both the entities and prepare a consolidated financial statement as given by the principles of AS 21. Okay, that is one thing all of you have to keep in mind, right? So, if B Limited is absorbed, the B Limited existence ceases, B Limited no longer continues to exist, then we will follow AS 14 accounting. AS 21 consolidation will come into picture only and only when B Limited continues as a separate entity. Okay. Now, why do we need consolidated financial statement, and how does it make a difference? So let us say we have Reliance Industries and we have Jio. Okay. Let us say Reliance Industries owns 80% of Jio. Now, when you as an investor, when you are buying Reliance Industries, you are not only buying thinking of what Reliance Industry does. What you are also thinking is, what is this business of Jio? How much value will I get from Jio? So your decision on Reliance Industry is dependent not only on Reliance Industry, but also on the Reliance Industries and Jio, on the entire group. You as a shareholder want to know what will happen when Jio does well. What is the impact on the share prices of Reliance Industry? What is the impact on the group profit? So for investors, they see this entire group as a single family. Like for example, in a family, you have parents, children. Parents do some business. Children are also doing some business. When an outsider sees as a family, what is your business potential? So you are seeing it as a what we call as group. So here also in consolidation, we are seeing the financial statements, we are seeing the business as a group and not as a single entity. We are seeing it as a group. Okay, that is one thing. Then, when we prepare consolidated financial statements, we are telling to the outsiders that as a group, what are my assets, what are my liabilities, what is my performance, what is my cash flow. Okay, and when we prepare consolidated financial statements in the examination, you will have same thing. You will have Reliance Industries Limited, you have Jio Limited. You will have balance sheet of Reliance Industries, you will have balance sheet of Jio. Reliance Industries, let us say, you have some assets, you have some liabilities, you have equity. You have liabilities, you have assets, and you have equity. But for the outside world, you give both of them as a single entity. Now, when the outside world sees, see this equity, and there is, let us say, a shareholder. Now here Jio has equity. Let us assume Reliance has 80%. Reliance has invested 80% in Jio. Reliance has invested 80%, means 80% of equity of Jio is held by Reliance. What will Reliance show here? Reliance will show here investment. So Reliance is showing an asset called investment, that is a part of this equity. Outside is what this is. See, this is your internal thing. This is your internal thing. We are not concerned with it. What we want to know is combined assets, combined liabilities, and net equity. That is how they want to see. So when we are preparing consolidated financial statement, you will add all assets, you will add all liabilities. You will not show equity of subsidiary. You will not show investment made by the parent company in the subsidiary. So Reliance Industry, which holds 80% of Jio, Reliance is called holding. Sometimes it is also referred to as parent. Jio is called the subsidiary. Holding plus subsidiary put together makes a group. So when you are preparing consolidated financial statements, you are giving the financial statements of the group. Now, as I told you in the amalgamation topic as well, that we calculate goodwill. So for consolidation also we will calculate goodwill. How do we calculate? Let us say Jio has net assets of 1000 crores. Reliance paid 1200 crores to acquire 80% shares in Jio. So Reliance paid 1200 crores to acquire 80% shares in Jio. Now, when Reliance has paid and acquired 80% shares in Jio, so whenever you have more than 50% stake, then we say there is a holding subsidiary relationship. Okay, in the examination they will tell you A has acquired 70% of B Limited, A has acquired 30% of B Limited, 60% of B Limited, some number. Whenever it is more than 50%, you understand that this is holding company, this is subsidiary company. Okay, that is one thing. Now if I have acquired 80% shares in Jio, so Jio has equity. Out of that equity I am saying 80% belongs to me, the holding company. So where is 20%? This 80% is the majority holder, 20% is called the minority holder. So in this net asset of 1000 crores, 20% belongs to minority. In this net asset of 1000 crores, 20% belongs to minority, which means holding share in subsidiary is how much? 80% of 1000 crores, that is 800 crores. To acquire this 800 crores, how much did we pay? We paid 1200 crores. So this 400 crores is called goodwill. Similar to amalgamation concept, in amalgamation we said purchase consideration and 100% net asset, because there we are acquiring all the business, entire business. If we don't acquire 100%, then it has to necessarily be a consolidation process and not an amalgamation process. It has to be a consolidation process and not an amalgamation process. Is that clear? So what is our share in net assets versus what we have paid? Our share in net assets versus what we have paid, the difference is called goodwill. Sir, if we paid less, then it becomes capital reserve. There also goodwill capital reserve, here also goodwill capital reserve. Okay. So when we prepare the consolidated financial statements, what you will take is, you will take assets of Reliance plus Jio. You will take liabilities of Reliance plus Jio. You will take equity of Reliance only. You will take reserves and surplus of Reliance only. Now, in this Jio's net asset, we are saying 20% belongs to outsiders. So, we will add one more item saying 20% of Jio belongs to minority. So, this is a new addition you will do. So, while consolidating, what you will do is, you will remove the investment in subsidiaries amount. You will remove the equity amount of the subsidiary, and you will introduce one item called minority interest. Of course, you can have goodwill and capital reserve depending on what is the question. right? So that is the broad understanding before we jump into the actual consolidation process. Here also you should follow step by step process, and you have to do the question. Now in most of the cases, this net assets that is acquired, right, we said we acquired 80% of the net asset. This net asset, can I say equity? Can I say equity? Right, equity means equity plus reserves, equity plus reserves and surplus, right? So the net assets that we acquire, this net assets that we acquire, we can compare that with equity, and this net asset calculation is done on date of acquisition. What is the net asset on date of acquisition? What is our share in that, and how much have we paid to acquire that? So that will give us goodwill or capital reserve, right? Now we understood holding company, which has control, subsidiary company, which is controlled. How do we get the control? Either by controlling composition of the board, or more than half of the total share capital, which has voting power. Group of companies, the holding and subsidiaries along with associates and joint ventures are called group of companies. This theory will be relevant for you in solving. Sometimes they may ask you MCQ based question. It will be important. Okay. Now this is very important. Now it may be possible that you have taken classes elsewhere, or you have done self-study. Any format, any pattern is okay till the time you ensure that there is a logical flow in which you are solving the question. Okay, till the time you have a logical flow in solving the question, there is no need to worry at all, right? First thing on the consolidation process is identify or ascertain the date of control. What is the meaning of date of control? Date of control means the date on which the holding company has gained control over the subsidiary company. The date on which holding company has gained control on the subsidiary company, you have to identify, and you also need to identify what is the percentage of control or percentage of holding. So for example, if the parent company or the holding company holds 80%, the minority interest will hold 20%. This breakup is important. Sir, why is this breakup important? Because we need to know how much we have to pay to the minority shareholders. So the first step, what you will do? The first step, what you will do? You will figure out what is the date of control. Okay. Second step, what will you do? The second step, you will calculate. You will figure out what is the percentage of holding of the parent as well as the minority interest. That is third. Then analysis of profit. Now here you have to keep one thing in mind. We said that we will compare the net assets with amount paid. Now when I say we compare net assets with amount paid, this net asset is as on date of acquisition, which is represented by equity share capital and what we say pre-acquisition reserves. Pre-acquisition reserves. So there are two ways to look at net assets. One is the total assets minus liability. Second is what is the pre-acquisition reserve. On that pre-acquisition reserve, on that day, whatever is the pre-acquisition reserve, that represents net asset. Equity share capital plus pre-acquisition reserve represents the net asset, right? Now, considering this amount, we will compare this with what amount we have paid and calculate goodwill or capital reserve. So what you have to do, everything, all the profits, you have to classify between pre and post acquisition reserves. Okay, so you have to be very careful. This is the most important step when it comes to consolidation. Carefully splitting between what is pre-acquisition, what is post-acquisition. Whatever is pre-acquisition will go into calculation of something called as cost of control, that is goodwill or capital reserve. I am repeating once again, whatever is the pre-acquisition reserve will go into the calculation of goodwill or capital reserve, which is also called as cost of control. Whatever is the post-acquisition profit will form part of the consolidated reserves and surplus in the balance sheet. So this is a very important step where you have to split all the reserves, profits and losses between pre and post acquisition. So whatever is earned up to the date of acquisition is your pre-acquisition, and that is a capital profit, and whatever is earned after that is your revenue profit. And so the logic is very clear. If I am acquiring a particular company as on 31st of March of 24, I am paying for the equity plus reserves, right? So this amount I'll compare with the amount paid, and that will give me the goodwill or capital reserve, right? Perfect. Okay. Now, when we have to do this analysis of profit, you follow a format, whatever format you have been following. Simple format could be, you have equity share capital, how much is pre, how much is post. Normally, so this equity share capital will be part of pre only, right? Then you have profits, profit or loss balance. How much is pre, how much is post, what is total. Now, in examination, most of the time what they will give you is, they will give you the total. This is as on date of consolidation. As on date of consolidation, what is the total balance? Pre is as on date of acquisition. So profit and loss, how much is on the date of acquisition, how much is on the date of consolidation, the difference can be considered to be post. Same way you will have general reserve. How much is there on date of acquisition, how much is there on the total date of consolidation, the difference becomes the post acquisition component. So like this, for each component of profits you have to split, you have to do the analysis and see how much will be the impact, or what will be the impact in pre and post. So what is the total profit, how much of that is pre-acquisition, how much of that is post-acquisition. For example, they say that as on date it is 1000, on date of acquisition it is 100, means 900 is post-acquisition. Okay. Now this pre-acquisition profit will go into calculation of cost of control, and this will go into your reserves and surplus. When we do a couple of questions, you will have more clarity on how do we do this analysis. Few specific things for you to keep in mind. Profit and loss which are earned up to the date of control or date of acquisition is called pre-acquisition profit. Sometimes you have to do a time-based adjustment also if it is acquired in the middle of the year. That also we'll have a look at it. All reserves of the subsidiary up to the date of control are to be considered as again pre-acquisition. So reserves, profit and losses, you have to do it. Then one very important thing is, there is a concept of revaluation on date of acquisition. For example, net assets have a book value of 1000. They have a fair value or revalued amount. They are revalued to 1200. What is the meaning of this? We are saying that we have acquired a subsidiary. The subsidiary says that we have 1000 as book value of net assets. We have 1000 as book value of net assets. Then the market value today, if we consider, is 1200. So while acquiring, we are putting a value of 1200 and accordingly paying the money, right? So what are we doing? We are increasing the value of assets. The subsidiary company is not doing revaluation as per accounting standard 10 in its book, okay? But for the purpose of consolidation, we are saying that no, the asset value should be 1200. We are increasing the value of asset. Now tell me one thing. If I am increasing the value of asset, is it a profit or a loss? It is a profit. Now that profit will increase my reserves on the date of acquisition, right? Now if the profit will increase my reserves on the date of acquisition, when I am doing this analysis, I will have one more revaluation which will increase the reserves, and this entire revaluation amount will be my pre-acquisition only. So please keep this in mind. In examination you will get a question where they will say property, plant and equipment has to be increased by so much. The let us say property, plant and equipment has to be reduced by so much. Anything you do, if there is a revaluation that has to be done, it will be a part of my pre-acquisition and it will increase or decrease the reserve. Now the next impact of this that all of you have to keep in mind and not miss is, if I am increasing the value of asset, then in the post-acquisition period, I need to charge additional depreciation. Don't forget this. in the subsequent period I have to charge additional depreciation. Similarly, if I reduce the value of asset, the depreciation has to go down in the post-acquisition period. So this adjustment is a critical adjustment and you should not miss this in the examination. So if there are any revaluation of assets or liability, you should be considered as capital profit, and corresponding depreciation after the date of revaluation is to be computed and adjusted in post-acquisition. Very, very important. Don't forget this in the examination, right? Then if there is cumulative preference shares on which dividend has not been provided for, you have to provide for the dividend on the date of acquisition. Interest on loans and debentures, you will adjust it against the profit. There is nothing. Bonus shares, again very important. If bonus if bonus shares are issued from pre-acquisition profit, then what you will do is, just see this carefully. Let us say we issue bonus shares of 100. You will add in pre-acquisition or in the capital 100, and from pre-acquisition reserves you will reduce. The impact is goodwill and capital reserve will not change. So if there is a bonus issue, please keep this in mind. If there is a bonus issue out of pre-acquisition profits, then you will add it to the equity share capital and you will reduce it from the pre-acquisition reserve. No problem. But if it is out of post-acquisition, then your equity share capital will change, and here it will be the change, which means your goodwill or capital reserve calculation will change. Okay, so that is one more thing you have to do. Then proposed dividend or dividend already paid, two adjustments. If it is out of pre-acquisition, then you will reduce it from the pre-acquisition profit, and as per accounting standard 13 principles, you will reduce it from the cost of investment. If it is a pre-acquisition dividend, you will reduce it from the pre-acquisition reserves and cost of investment. Again, goodwill or capital reserve will not be impacted. If it is out of post-acquisition, then you will reduce it from the post-acquisition reserves and add it to the post-acquisition reserves of the holding entity. So normally what happens is, because of dividend, there is no impact in your overall numbers calculation, but it has to be presented correctly. Okay. Now the most important thing, as I told you, is this analysis table. When we do a question, you will have 100% clarity of this. We have given in summary format how to do the accounting for dividends. You can have a look at it. I have already discussed. Then uniform accounting policies, again very important. If at all the accounting policies differ between two entities, then based on what the holding company is doing, you have to update the numbers of the subsidiary, right? So far what all we have seen. First is, what is the date of control or acquisition. This is the first step. Second step, what I have to do is, what is the percentage holding. This is also simple. Okay, this step where you have to do analysis of profits. So here you prepare this table: P&L account, reserves and surplus, revaluation surplus, capital reserve, any reserves, how much is pre, how much is post, okay, and what is the total. Let us say pre is 100, post is 200, total is 300. This is as on 31st of March given in the question. Reserves and surplus, pre is 80, post is 20, total is 100. Revaluation surplus 100, there is nothing post, but this revaluation surplus has, let's say, caused 10% depreciation. You need to consider 10% depreciation. So here you'll have minus 10, so this will become 90. Not revaluation surplus as such, but the net amount. Then the capital reserve, let us say it is 20, then it is 30, then it is 50. Okay. Now all these numbers, see, you have separately equity share capital that you will handle separately. All this number you have to see what is holding, what is minority. And this analysis of profit we are doing for a subsidiary. Okay, we are not doing for the holding entity, we are doing it for the subsidiary entity. Now what you have to do is, holding, let us say, is 80%. So 100, 200, 300. This is total of 300. This is 200, 20, 210, 240. Okay. 80% of 300, that is 240. This will go to cost of control. And 300 into 20%, 60 will go to minority interest. Same way for post, 240 into 80%. If I have to do 240 multiplied by 80%, 240 multiplied by 80%, it is 192. 192 will go to reserves and surplus, and the balance amount, that is 58, no, not 48, 48. 48 will go to minority interest. Okay. So what you are saying is, out of the total reserves, 240 is used in calculation of cost of control, 192 will go into the reserves and surplus, 60 will be minority interest, and another 48 will be minority interest. Right? This is what is called the analysis of profits. Now, the next important calculation is minority interest. What is minority interest? The amount from the subsidiary's net asset that I have to give it to the minority. Now, what will minority ask? It will ask me 20% in equity share capital. It will ask me 20% in pre-acquisition profit, and it will ask me 20% in post-acquisition profit. Okay. So this calculation I have to do and present this as a minority interest in the balance sheet. Clear? Minority interest in the balance sheet. Then we calculate cost of control. What is cost of control? Total amount paid minus net assets. Now this net assets comprises of what? Equity share capital plus pre-acquisition profits, which belongs to holding company or parent company. So total amount paid minus the pre-acquisition profit plus the equity share capital, which belongs to the holding company, gives me cost of control. If I have paid more, it is called goodwill. If I have paid less, it is called capital reserve. So goodwill, amount paid minus share of net assets, that is equity on the date of investment, opposite is capital reserve. Right? Now, let us have a look at a question where we will understand how to calculate the goodwill and the capital reserve portion and the minority interest calculation. Okay. Is it clear so far, or do you have any questions? Please let me know. Okay, all clear? Great. Sure. So let's look at this simple calculation. Now the thing you have to keep in mind is, in this chapter consolidation also, if you are able to calculate cost of control correctly, and if you are able to do the analysis of profit correctly, then if you are able to calculate minority interest and the adjustments of intercompany transactions, the balance sheet preparation is not a challenge. Balance sheet is again holding plus subsidiary, line by line you should add. Okay, so while revising, your focus should not be perfecting the balance sheet. Your focus should be perfecting the cost of control, goodwill, and all of those calculations, right? EXE Limited acquires 70% equity shares of Z Limited on 31st of March at a cost of rupees 70 lakhs. Following information is available in the balance sheet as on 31st March of 17. So on date of acquisition, what is the date of acquisition? Date of acquisition is 31st March. Fixed asset 120, investment 55, current asset 70, loans and advances 15, debentures, current liabilities. The following revaluation have been agreed upon: fixed assets by 20%, investment by 10%. The Z Limited declared and paid dividend of 20% on its equity shares as on 31st March. EXE purchased the shares of Z Limited at 20 per share. Calculate the amount of goodwill or capital reserve on the acquisition. Again, can be an MCQ question for 2 marks. Okay, not this big, slightly smaller. Now, when we are calculating cost of control, that is goodwill or capital reserve, you have to see what is the amount paid. The amount paid is 70 lakhs. So the total amount paid is 70 lakhs. Then what they have said is, they have acquired shares of Z Limited at 20 per share, and Z Limited declared and paid dividend of 20% on its equity shares on 31st March of 2017. So there is a equity dividend component what they have paid. How much have they paid? They have paid 20%. Okay. Now, if they have paid 20% of dividend equity shares as on 31st March, it's not properly drafted question actually. What they're trying to say here is there is a pre-acquisition dividend which you need to account for. There is a pre-acquisition dividend which you need to account for. Now, how much is the pre-acquisition dividend? We have purchased 70 lakh shares, and 70 lakh shares, each share is 20 per share. 20 per share. So we have purchased 35 lakh shares. We are assuming that the face value is 10. So on 10 at 20% you will pay 2 rupees per share. So not 35 lakhs, 3.5 lakhs. 3.5 lakhs into 2, 7 lakhs is the dividend. So what you have to do is this dividend has to be reduced from the pre-acquisition profits and also from the cost of investment. See, as per accounting standard 13, any dividend paid out of profits before acquisition, that has to be reduced from the cost of investment. So now your cost of investment will be 70 minus 7, 63. 70 minus 7, 63 is your cost of, cost of investment. Then let us see the net assets. So when you calculate the net assets, fixed asset is 120 to be increased by 20%. So 120 plus 20%, it becomes 144. Then investment down by 10%. So 55 minus 10%, it comes down to 49.5. Then you have current assets, loans and advances as it is. Current assets, loans and advances as it is. Then equity share capital. We have acquired 3.5 lakh shares, which is 70%. 3.5 lakh shares is 70%. So what is the total number of shares? Total shares will be 3.5 divided by 70%. That is 5 lakhs. So the total shares is 5 lakhs and the total amount is 50 lakhs. Debenture is given, current liability is given. This 88.5 is the reserves and surplus balance, which is the balancing figure. Right? Now, how do we do the analysis of profit? On the date of acquisition, you have 88.5 as the pre-acquisition profit. Now, how do we get that 88.5? There are two components. One is your normal reserves and the second one is your adjustment for revaluation. So, if you see the revaluation adjustment, just a moment. Yeah, the revaluation adjustment is from fixed assets 24 up and 5.5 investments down. So 24 minus 5.5, it brings it down to 18.5. This is the revaluation and balance is the normal. Okay. So this is the total. Now out of this pre-acquisition profit, they have paid dividend of 20%. They paid dividend of 20%, which comes to 10 lakhs. So you will reduce this from pre-acquisition profit and you will get 88.5. Reduce and so again add back because this number is after dividend. Sorry, so I missed that part. This is after dividend. So it is 88.5 only the total reserves. So out of the 70%, 61.95 goes to the holding company and 26.55 goes to the subsidiary, the minority interest. Okay. Now, the other way to do this in the examination, if you have to do in a simplified manner, is what is the net asset? Net asset is 120 plus 20%, that is 24. This is 144. This is 55 minus 5.5, which is 49.5. This is 70. This is 15. Okay. So 144 plus 49 plus 70 plus 15. This number 278.5. 278.5 minus 140. What you are left with is 50 plus 88. 278.5 minus 140. 50 plus 88, that is 138.5. Out of this, 70%, 138.5 into 0.7, 61.95 plus your equity 35, 96.95. So what we can do is, out of this 138.5 into 70%, if we do, how much do we get? 138.5 into 70%. 138.5 into 70%, we get 96.95, right? So that 96.95 includes my 70% of share capital and profit, 96.95. So the total amount paid is 63. 96.95 is the net asset. So the capital reserve becomes 33.95. Capital reserve becomes 33.95. Now let's have a look at how do we handle a consolidated related questions, and what are the indices that you have to be careful about while solving the question. From the following summarized balance sheets of H Limited and its subsidiaries H Limited drawn up to 31st of March of 17, prepare a consolidated balance sheet as at that date having regard to the following. Reserves in profit and loss account of S Limited stood at 25,000 and 15,000 on the date of acquisition of its 80% shares of H Limited. See, so many information they have combined it and given to us in a single statement. Right now, what is the first one? The first one, what they're saying is 25,000 and 15,000 is the reserves and P&L balance. This is the date of acquisition, so you have to highlight this number. This is 31st March of 2017, which is the date of consolidation. Now here in S Limited, what is the reserves balance? 75,000. What is the profit and loss account balance? 25,000. So what does that mean? This 25,000 is here and 15,000 is here, means 15,000 is date of acquisition, 25,000 is date of consolidation, 10,000 is post acquisition. Same way, 25,000 is here, you have 75,000 here, 50,000 is post acquisition. Machinery book value of 1 lakh and furniture book value of 20,000 of S Limited were revalued at 1,50,000 and 15,000 respectively on 1st of April. Now what does this mean? We have done an upward valuation or we have done a downward valuation. So if you have done an upward valuation, what we will do? We will add it to our pre-acquisition reserve. If you have done a downward valuation, what we will do? We will reduce it from the pre-acquisition reserves. For the purpose of fixing the price of its shares, rates of depreciation computed on the basis of useful life, machinery 10%, furniture 15%. Okay. Balance sheet is given, H Limited and S Limited. So you have shares, you have reserves, you have P&L account balance, trade payables, machinery, furniture, other non-current assets, non-current investment, shares in S Limited, 1,60,000. This is by whom? By holding. Now, to do this, first we have to focus on the working note, and the most important part is this analysis of net profit or analysis of profit. Now, always what you will do is this total column will be your as on the date of consolidation, 75-25. What are they given on the date of acquisition? Reserve they said 25, P&L they said 15. Means what? Post acquisition 50,000 is the post acquisition reserve and P&L post acquisition is 10,000. That is one. Okay. Then second thing what they have told us is, they have told us that we have done a revaluation. What is the revaluation? We have increased the value, machinery and furniture, revalued at 150 and 15. So this 1 lakh became 150 and this 20,000 became 15. So machinery plus 50,000 and furniture minus 5,000. So machinery plus 50,000 and furniture minus 5,000. What you have to do is you have to adjust here like this. In the pre-acquisition revaluation, 50,000 and 5,000. Now the next important thing which you should not be missing out is that if I am increasing the value of an asset, I have to charge more depreciation subsequently. Now this change of 50,000 and 5,000 is not being done by the subsidiary company. This is done only for the purpose of consolidation. This is done only for the purpose of consolidation. Then who will do this change? Only in the consolidated financial statement. Is the subsidiary charging more depreciation? No. Is the subsidiary charging less depreciation? No. Right. So in the subsidiary is not charging depreciation for this extra amount. When should we charge? In the consolidated financial statement, in the post acquisition reserves or post acquisition P&L. So 50,000 10%, 5,000 more charged. For furniture the value has come down, so the depreciation also has to come down. If depreciation has to come down, my profit has to increase. So 750 increase in the profit. So this is the adjustment. Okay. Now in the pre-acquisition, what we can see here, in pre-acquisition what we can see here, 40,000 of this plus 45,000 of adjustment, 85,000 of pre-acquisition reserve. Out of this 85,000, 80% is holding, 20% is minority. So 85,000 into 80%, we get 68,000. This will go for calculation of cost of control, and 17,000 will go to minority interest. Same way from the post acquisition reserve 80% and post acquisition P&L 80%. Okay. Now cost of control, how much did we pay? 1,60,000. How do we get that? That 1,60,000 is given to us in this balance sheet. Now when we are doing the consolidation, what you have to keep in mind is this 1,60,000 I will not show. This shares of S Limited I will not show. Reserves I will not show. And the P&L account I will not show. So what will I show? This investment is gone, this equity is gone. Whatever I have to pay to the minority interest, I will add one minority interest item, and that 20% whatever is there in the minority interest, that is what I will show. Apart from that, I will not show anything. Okay. So coming to cost of control, investment 1,60,000. How much is my share capital? 80,000. How much is coming from analysis of profit, the capital reserve portion? 68,000. So 68,000. 160 minus 80 minus 68 is 12,000. This is what? This is my goodwill. This I will add to the consolidation. Oops. So phone just skid off, sorry. Yeah. So 12,000 is what I will show in goodwill, and this I will add it to the consolidated balance sheet. Okay. Now the next thing that you have to calculate is minority interest. Minority interest means the amount that I have to pay to the outsiders. What will I pay? Whatever is 20% of equity share capital in this case, plus whatever was pre-acquisition reserves, plus whatever is post-acquisition profit. Where will I get this from? I will get this from this table. So what I have to do is blindly take 17,000 plus 10,000 plus 1,150. Pre-acquisition profit, reserves, and minor post-acquisition P&L plus, so 17, 10, 1,150 plus 20%. So 48,150 becomes my minority interest. Where will I show this? I will show this in the consolidated balance sheet. Okay. Then from the point of view of when we are doing the consolidation, the last thing that you have to do is what is the consolidated reserves? What will you take? Holding company, you will take 100% of P&L and reserves. Holding company will take 100% of P&L and reserves, and from the subsidiary company, whatever is my post-acquisition component, that I will take. So how much is that? That we have calculated here, 4,600 P&L, 40,000 reserves. 4,600 P&L and 40,000 reserves is what I will consider, right? So what I'll do, 40,000 plus 4,600 is my post acquisition component, which I will take in the reserves. So 4,600 and 40,000. So this becomes my consolidated number. Now here if I tell you, this 5 steps is where you have to pay a lot of focus on while revising. Okay, these 5 steps is where you have to pay a lot of focus on while revising. If you are done with this, then there is no problem at all. You will be able to solve the question. Sir, how to prepare consolidated balance sheet? No problem at all. Consolidated balance sheet. Property, plant and so let us say one by one. Asset side. Take S limited, machinery as it is, you can add. Then H limited once you add, then you have appreciation. There is some alignment issue, sorry for that. There is some appreciation. So this appreciation also you have to consider. So if you see, I'll do it. There is an alignment issue. So if you come back to the question, 3 lakhs is the machinery, and these 3 lakhs have been taken to what? I think there is an issue in the, but anyways, I'll explain you with the logic. So what I do is 3 lakhs is the machinery value, then you have 1,50,000 of another machinery value. So I think there is an error here. Just give me a moment.
It's 1 o'clock.
So I think this is not a proper presentation. This has been taken from the study material and this is not the right way. I'm sorry for that. So what you have to do is 3 lakhs is the H limited number. For S limited you have to take 90,000. Okay, S limited you have to take 90,000. On this 90,000 there is an appreciation of 50,000. You have to add that, and there is an additional depreciation of 5,000. So 90 plus 50, 140. 140 minus 5,000 is 1,35,000. This is how you have to show it in the examination. Okay, so that's how this 1,35,000 number has come. Take the net values as given in the book, as given in the question. Right. Same way for furniture, you have 1,50,000 of what is there already given. Then 1,50,000 add 17,000. From this 17,000 there is a downward valuation of 5,000, and the depreciation impact on this, what we have calculated, $750. So plus 750. So 17 minus 5 is 12. 12 plus 750 is 12,750 plus 1,50,000. If you do, you will get this number. So I'll just present it in a different way so that you don't miss it out in the examination. For presentation of PPE which has been revalued, what you will take is, you will take holding company 100%, subsidiary company 100%, add revaluation surplus less additional depreciation. So this number what you get, this is what you will present in the financial statement in the consolidated balance sheet. Okay, so that is how you can present this. Then goodwill as calculated, you can present it, and other non-current assets as given in the question. So while preparing the balance sheet, what you have to keep in mind is, you ensure that you add them properly line by line. Don't take equity share capital of subsidiary, don't take reserves and surplus of the subsidiary, don't forget to add minority interest. Now when you prepare minority interest as done in the working note, you can add share capital only parent, only holding, reserves and surplus working note, trade payables parent plus subsidiary, and this we have already discussed. So this 2,40,000, 1,04,000, it comes directly from the working note. $2,40,000 plus 1,04,600. $2,40,000 plus 1,04,600. Okay, 1,40,000. So this is 344,600. There's some typo error while I was copying, so that is why it has resulted in this thing. Right. So this is how you can solve the question on consolidation. Now coming back to the theory. So far what we have done, we have seen how do we calculate, how do we do the analysis of profit, and if you have followed a very different format of doing the analysis of profit based on where you have taken the classes from, it is perfectly fine, you can follow that. The only thing is splitting between the pre-acquisition and post-acquisition component. Okay. Then calculation of minority interest, equity share capital plus pre-acquisition plus post-acquisition. Now one more thing, this minority interest cannot be negative. If it is negative, then the holding company has, or the parent company has to absorb their losses. Then we have seen this calculation of goodwill. Now very important, elimination of intercompany transaction or intra-group transaction. Now what does that mean? Say for example, Reliance Industries Limited has given loan to Jio. In Reliance Industries there will be an asset called loan. In geo-financial statements, there will be a liability called loan. Now, what we have to do is when we are presenting it to the outsiders as a group, this loan which is receivable and payable within the group is irrelevant. So, any amount of receivable or payable within the group we have to eliminate. Eliminate means what? You will not show it in the asset, you will not show in the liability. If there are trade receivables, there are trade payables, you will eliminate. You will not show in the asset, you will not show in the liability. Whether it is holding subsidiary, any intercompany balances will not be presented in the consolidated financial statements. They have to be eliminated in full. They have to be eliminated in full. That is the first thing. Second thing is, sometimes there is inventory sale. Let us say holding company sold goods costing 1 lakh at 1,20,000 to subsidiary. Holding company sold goods costing 1 lakh at 1,20,000 to its subsidiary. Now, when you sell goods costing 1 lakh at 1,20,000, subsidiary will show inventory at how much? 1,20,000. When you consolidate the financial statements, what is the cost of that? The cost of that is only 1 lakh. So, if my cost is only 1 lakh, can I show it at 1,20,000? I cannot show it at 1,20,000. I cannot show it at 1,20,000. So 1 lakh and 1,20,000, this profit of 20,000 is called unrealized profit, and this unrealized profit has to be eliminated. Sir, eliminated from where? You will reduce from inventory and you will reduce from reserves of whoever has made the profit. If holding company has sold, you will reduce from the reserves of the holding company. If subsidiary company has sold, you will reduce from the reserves of the subsidiary company. Okay, so that adjustment will be done. So if there are unrealized losses from intra-group transaction, they should be eliminated. So if there is unrealized profit in inventories, when one company sells the goods to another company and it is unsold, unrealized profit is eliminated from group profit. Closing inventory will be valued at cost. For upstream transaction, profit should also be reduced from minority interest. Meaning to say, if it is holding to subsidiary, remove 100% profit from H. If it is subsidiary to holding is called up transaction. Holding to subsidiary is called down transaction. If it is subsidiary to holding, which is an up transaction, then in that case, profit will be eliminated from subsidiary. So the logic you have to remember is which company is selling. If holding is selling, reduce from holding. If subsidiary is selling, reduce from subsidiary. So if I am reducing from subsidiary, holding also gets impacted, minority interest also gets impacted. So this adjustment, what you can do it in the analysis of profits directly, so that holding and subsidiary gets automatically impacted, right? So two things, intra-group balances you will remove, unrealized profit you will remove. If holding has sold, everything you will remove from holding company. If subsidiary has sold, you will remove everything from the subsidiary company. Then you have to calculate consolidated reserves, that is the consolidated reserves balance. Balance to be shown as per holding company 100%. Holding company share of post-acquisition profit as per working note. Capital reserve, pre-acquisition dividend you will reduce, and any unrealized profit you will reduce. This is the final thing. Share capital only of holding company, reserves as you have calculated in working note, liabilities holding plus subsidiary minus intra-group, non-current holding plus subsidiary plus any adjustment and goodwill, inventory holding plus subsidiary minus unrealized profit, investment whatever is outsiders, cash and cash equivalents holding plus subsidiary. Right? So this is how you will prepare the consolidated financial statement or consolidated balance sheet. So what we'll do is we'll take a break now, lunch break. I'm also slightly hungry. We'll assemble back at 2 o'clock. And we'll continue our discussion on consolidated financial statement. We'll take one exam problem also, and we'll also take the of one more question from the material and one examination question. At 2 p.m. we will reassemble, and after that we will move to internal reconstruction. So in the meanwhile, you can also finish up your lunch and we will reassemble back. Thank you. Check. Yeah. So welcome back, guys. We'll continue with examination question on consolidated financial statements, and after that we will move to internal reconstruction. The balance sheets, I hope it is okay, great. The balance sheets of Art Limited and Craft Limited as on 31st March of 24 are as below. Equity, liability, shareholders, share capital, reserves and surplus, and this is as on 31st March of 24. Then you have trade payables, short-term borrowings, non-current assets, non-current investment. Now see, you have non-current investment here you don't have. So this basically would include some investment in Craft Limited. And I have suggested earlier as well that you should not be wasting time in reading the numbers and all at this point of time. Okay. Then inventory, trade receivable, cash and cash equivalents. Perfect, fine. Then you have share capital 6,500, 4,000, reserves and surplus, general reserve P&L, short-term borrowings, bank OD, PPE, land and building, plant and machinery, non-current investment, investment in Craft Limited at cost. Now this will be used to calculate cost of control. Art Limited acquired 3,200 ordinary shares of Craft Limited on 1st of October. So in all the questions they will tell you that we have acquired some number of shares. It is, audio is slow. Okay, just a moment, let me increase it. Now can you let me know if it has become suddenly very loud? You can reduce the volume at your end. Is it fine now? Is it fine or not? Okay, fine, right? Fine. So they acquired 3,200, and in all the questions in the examination, you don't need to worry about who is controlling the composition of board of directors, this and that. That is all for theoretical MCQ purpose. 3,200 of Craft Limited. How many shares do they have? They have 4,000. So what is the stake? 3,200 divided by 4,000, 80%. This is the first thing you should calculate. Put it down in the working note so that all your calculations become easier. The reserves and surplus and profit and loss account of Craft Limited showed a credit balance of 40,000 and 58,700 on 1st of April of 23. Now what does this mean? 40,000 and 58,700 is the balance as on 1st of April of 23. Now one important thing in the question when you read, you have to figure out that acquisition happened on 1st of October and the numbers have been given as on 1st of April of 23. Of course, this number that they have given 40,000 and 58,700, these are a part of our pre-acquisition. But when we have to calculate pre-acquisition, we need to see from the date of acquisition. So 1st of April of 23, acquisition is on 1st of October of 23. So this period is post, this period is pre. So just because they have given this 40 and 58,700, don't blindly take this number and put it in your analysis of reserves. Of course, this is pre, but whatever profit they have earned during the year, even in that earning, half of that is pre-acquisition, half of that is post-acquisition. So friends, this type of adjustments you have to be very careful, especially with the dates. That is why noting down the date of acquisition or the date on which we got the control is very, very important, right? Okay, come on. The plant and machinery of Craft Limited, which stood at 2,50,000 on 1st of April, was considered worth 2,20,000 on the date of acquisition. Depreciation on plant and machinery is calculated at 10% per annum on the basis of useful life. So you have a number 250. On this you will charge 10% per annum, basically half your depreciation, and now it is valued at 220. So we have to see whether it is a downward revaluation or upward revaluation. The revaluation of plant and machinery is to be considered at the time of consolidation. Of course, even if they don't say, we have to consider. Kraft Limited deducts 1% from trade receivables as a general provision against doubtful debt. This is not followed by Art Limited. Now, who is Kraft? Kraft is the subsidiary. Kraft is providing provision for bad debt. Art says, I don't provide. What we will do? We will reverse the provision and will accordingly increase the P&L balance. Okay. Then, on 31st March, Kraft Limited inventory includes goods which it had purchased from Art Limited for 1,03,500, which made a profit of 15% on cost price. Now, as I told you earlier also, if they give something like 15%, you will not be immediately able to convert that. So, what you will do? Cost. So, on cost, right? So, you will take cost 100, profit 15, selling price 115. Now, here it is 1,03,500. What is the profit? Do a simple cross multiplication. 1,03,500 multiplied by 15 divided by 115. So 1,03,500 into 15 divided by 115 into 15 divided by 115 is 13,500. This is the unrealized profit component. This is as on 31st of March. Okay. Right. So that is the information. Now, what is the critical thing here you have to do? First is to handle this adjustment. When we are analyzing the pre and post incorporation, we have to pre and post acquisition, we have to handle this adjustment related to profit for half year. This is also called as time adjustment. This is also called as time adjustment. So when you do the analysis of reserve, there itself you do this time adjustment to arrive at the proper profit. So let us see how you can present that. So opening balance of general reserve is given to be 40,000 and P&L is given to be 58,700. This is analysis of profit of whom? Subsidiary. Okay, so in the question they have said 40,000 is the opening balance, closing balance general reserve is 40,000, P&L is 2,08,000. So, and there is no dividend declared. If there is dividend declared, for that you have to make a separate adjustment. What you are trying to find out? Profit earned during the year. If opening balance is 58,700, closing balance is 2,08,000, there is no dividend declared during the period. The difference of these two, 1,49,300, that is the profit during the year. That is profit for the full year. That is profit for the full year. We have to make it half. So 74,650, 74,650, 1,49,300 divided by 2. This is the profit for half period. Now, how do we do the analysis of profit? Pre-acquisition and post-acquisition. First is whatever balance is given on 1st of April of 23. That is 40,000 plus 58,700. That is my pre-acquisition profit. Directly I can write under pre-acquisition column. Sir, can I split between P&L and general reserve? For pre-acquisition not needed. For post-acquisition you can do. Okay. So 98,700 is fully my pre-acquisition profit. Then out of this profit, half profit is pre-acquisition, remaining half is post-acquisition. Then they have said we don't provide any provision for doubtful debt of 1%. So what is the doubtful debt or what is the receivable balance? Trade receivable is given to be 168,300. Trade receivable is given to be 168,300. Now we as a holding company, we don't need that 1% provision. So what we have to do, that 1% provision we have to reverse. That 1% provision we have to reverse. Now don't do this mistake in the examination where you take 168,300 multiplied by 1%. No, this is 99%. This is not 1%. This is 99%. So what is 1%? Full 100%. 168,300 divided by 99%. If I do 168,300 divided by 99%, if I do, I get 1,70,000. 1,70,000. On this 1% is 1,700. So what I have to do, that for half year period, whatever is the number, 850, 850. How did I get the 1,700? You can, the same working note what we have done. 168,300, that is 99%. So 100% will be 1,70,000. So 1,700 divided by 2, 850. Okay. So 850 I have to adjust. Adjust means I have to add back. So this will increase my pre-acquisition profit also. This will increase my post-acquisition profit also. Sir, what do we do of the previous provisions and all? So that we will not be able to know because we don't have the sufficient information. Otherwise, it is on a cumulative basis. Okay. Then, so we are done with the opening balance, P&L and this. Then we have revaluation for plant. Now, what is the revaluation portion? So here what they have given is in the question. The plant and machinery stood at 2,50,000 on 1st of April, 10% per annum. So, plant and machinery opening balance is 2,50,000. Depreciation for 6 months is how much? Is at 10% per annum. So, that is 5%. 12,500. Okay. So, carrying amount is 250 minus 12,500. 237,500. 237,500. They are valued at how much? 2,20,000. So 2,20,000 if I take, the revaluation amount or downward revaluation is 17,500. 17,500. So that is the amount of downward revaluation. 17,500 is the revaluation loss. This will be taken on which date? On date of acquisition. This will be taken on date of acquisition, right? So here you can see how they are presented. Balance given is 2,50,000. Depreciation 237 minus 220, 17,500. This is the revaluation loss. As on which date? As on 1st of October of 23. This we have incorporated. Now, please note, the subsidiary company will continue to charge depreciation on 2,50,000 for the remaining 6 months. Here, we cannot directly take 17,500 into 5% because company will continue to charge depreciation on 2,50,000. So, how much will they charge? For the next 6 months also, they will charge 12,500. How much should we have charged? On 2,20,000 for 5%, we should have charged 11,000. We should have charged 11,000. So 12,500 minus 11,000, 1,500 is excess depreciation. Means subsidiary has charged extra depreciation, which we are now reversing. This adjustment will be done in the post-acquisition period. So coming to the post-acquisition period, we will do this adjustment. So just to summarize this entire working, first we took opening balances as given. Then we took the profit for 6 months for pre and 6 months for post. Then reversal of provision for pre as well as post. Revaluation loss, we calculated 17,500 and difference in depreciation is 1,500. Difference in depreciation is 1,500. So that is one more component. Then by doing this, we get the total pre and post. 80% parent. This will go to cost of control calculation. So this 125,360, you can see here cost of control calculation, and this part and this part, the minority interest part will go to minority interest calculation, and this part will go to post acquisition. So this plotting is very, very important when it comes to consolidated financial statements, right? Now, one more thing, here savings in depreciation, if it was a full period, directly you could have taken the difference and multiplied it with 10%. But here, because it is half period, we are separately calculating and saying how much depreciation has been excess provided. Okay. Now for cost of control, investment is taken from balance sheet. Share capital, cost of control, you will calculate the goodwill or capital reserve. Minority interest, share capital, capital profit, revenue profit, the total amount. Consolidated P&L. As per balance sheet, P&L and general reserve, revenue profit 61,600. So here you can see this comes from this portion. Then unrealized profit 13,500 we already calculated. This 13,500 should also be adjusted from inventory. So when you calculate inventory, here you will reduce 13,500. Right. Now coming to consolidated balance sheet, how we need to do it? We just need to take line by line item from each category. So share capital only parent. Okay. Then reserves and surplus as per our working note number 5 for P&L capital reserve that we have done, and capital reserve working note number 3 that came from cost of control. Minority interest we have already calculated. Short term borrowings as it is you can take. Property, plant and building, add the respective amounts, and please note this adjustment, that is downward revaluation of 17,500 plus depreciation reversal of 1,500. This adjustment you have to keep in mind. Then inventory, this unrealized profit adjustment, that's it. So once you do the total, you can present the balance sheet. Now here also, this would be some 3 marks. Notes to accounts 1, 2, so 1, 2, 3, 4. 4 marks for notes this, 7, then 2 marks for this, 9, 2 marks for this, 11, 12, 13, 14. So 1 mark here and there. Okay, I'm not able to exactly estimate. 1 mark here and there, they would have done 0.5 or something like that. But then, if you know the steps and if you are able to plot these numbers properly, you will be able to handle it very, very easily. The thing you have to keep in mind while solving a consolidated financial statement problem is that first, figure out what is the date of acquisition. On that date, what is this pre-acquisition profit? And the balance is post-acquisition. First is pre, then balance is post. If required, you can use the total column. But here, since they have directly given to us, so there is no further requirement to do any of that adjustment, and we have calculated it from here. Okay. Then one thing what you can keep in mind to ensure that you don't miss out anything. So for example, there is an unrealized profit in any of the component. So this is an adjustment. It will come twice. Why twice? One in the P&L, second while doing the inventory. So you have to keep that in mind. Same way, revaluation profit. Now here you have a revaluation number of 17,500. It will come twice. One in cost of control, second in the balance sheet under PPE. Then the depreciation impact of this again will come twice. One in the P&L, second one in the balance sheet, right? So that is how when you follow this structured approach, it becomes easy. And this time adjustment you be very careful about, especially when the date of acquisition is in the middle of the year. When the date of acquisition is in the middle of the year, time acquisition becomes very, very important. Okay, I hope you have been able to understand this consolidation approach in a structured manner. Once in a while you may get a question which is very tricky, which is very difficult. No need to worry about that. If that happens, you can leave it as a choice, but otherwise please don't leave these two questions, amalgamation and consolidation. Sir, I get scared because of consolidation, I get scared because of amalgamation. Then you can do it towards the end. One thing, not more than 30 minutes. You are not spending more than 30 minutes. If you cannot reach the answer within 30 minutes, after 30 minutes you will leave it, move to the next question, and then come back subsequently. And in all of these, some small questions can come in MCQ, like MCQ related to calculation of purchase consideration, calculation of goodwill, calculation of capital reserve in both the cases, right? And be very careful about intercompany transaction unrealized profit. Unrealized profit, I am again repeating, if it is downstream holding to subsidiary, 100% holding you will reduce. If it is upstream subsidiary to holding company, you will reduce it. Let's say 80% from holding, 20% from minority. So the way to do the adjustment is adjust in the subsidiary reserves. Where to adjust? You can adjust it here. In the post acquisition, here you can adjust the number. That will help you to get it done. Okay. Now, Now we'll move to the next chapter, which we had thought, internal reconstruction. Again, a highly scoring chapter as far as the examination is concerned. Very, very straightforward. Only thing that can make this chapter difficult for you guys is the English wording. The way they write the sentence in the adjustment. Creditors took 50%, then they waive of 25%, then they took some shares, then they did this, then they did that. That is where it can cause trouble. Otherwise, in internal reconstruction, there is nothing for you to be scared about. Okay, again, a likely 14 marks question for the from examination point of view. from examination point of view, likely question, and as I told you, again I am repeating, only thing that can trouble you is understanding the adjustment given. Apart from this, there is no adjustment or a tricky part in internal reconstruction. It's a very simple and straightforward chapter. I will tell you how to read. If you read it slowly, break down the adjustments into bits and pieces, you will be able to handle this particular chapter. Okay, so let us now when you talk about internal reconstruction, this happens when there is a troubled company. We are not bothered about what is the trouble the company is going through. We are bothered about how to do the accounting. Okay, see, from when you're preparing for the examination, why it is happening, who has happened, who has approved. No, how do we do the accounting? That is more important. Now, when we say internal reconstruction, it's a troubled company. Let us say we have some asset, liabilities. Assets are 2000, liabilities 3000. Equity share capital 500, right? So the difference, that is debit balance in, let us say, P&L is 1500. Troubled company doesn't have money to pay, so what they do, they will go out and say, see, liability holders, we have only 2000 of asset, we cannot pay you fully, and if you want the full money, you have to let us continue the operations, you have to help us to work so that we can pay your money back. Right? That is what is the proposal. So what happens is, these liability holders, these equity shareholders or the preference shareholders, all of them get together and say, okay, we will give away some amount to you, we will give up some amount to you. With the balance amount, you continue to run the business and subsequently you can pay us. That is fine. Now the thing you have to keep in mind here is, whenever these liability holders or equity share capital, equity holders, when they give up some amount, when the liability holders say, you have to pay me 3000, right? Don't pay me 3000, pay me only 1500. What has happened here? Here, the company has actually gained. A liability reduction is actually a gain. So what you are required to do is, any gain that is happening because of this activity of negotiations with the creditors, equity shareholders and all of these things, any type of gain that is happening, that you have to record in an account called capital reduction. Now this capital reduction account, think of it like a revaluation account. The capital reduction account is nothing but a revaluation account. All gains you put it here, all losses you put it here. All gains you put it here, all losses you put it on the debit side. Credit side gains, debit side losses. Finally, whatever is the number left over, that will be used to write off accumulated losses, fictitious assets and all of those things. Okay, so the way it works is, if let us say liability holders say we need only 1500, so you will say credit side by liabilities 1500. We have gained something. Okay. Same way, if there is a loss, let us say we sold off some investment at loss, so that you will record on the debit side. By doing this, what you are doing is, you are trying to get some cushion, get some funding from others, and based on that, you will write off any fictitious losses which are no longer required, and you want to continue the business. This is the overall structure. Think of this capital reduction account as the revaluation account itself. Nothing. Now, what you have to understand in internal reconstruction is that one important aspect that happens is reduction in share capital. Reduction in share capital means what? Say for example, currently we have share capital of face value 100. Okay. Now the company is going through trouble, so equity shareholders come and say, okay, we don't need 100, you bring down the face value to 20. So 100 to 20 means there is a gain of 80. There is a gain of 80. How do we record this? Existing share capital, we are writing it off, and we are bringing in a new capital of 20. So what you will do? You will debit share capital. So you will say equity share capital face value 100 debit by 100. You will create a new capital to equity share capital face value 20 20, and the balance amount is your capital reduction 80. So what are you doing? You are cancelling out the existing shares, bringing in new share, and the difference is your gain. So difference is your gain. Okay. So if you reduce the paid up value from 100 to 20, so this is a paid up value 100, now it is become 20. So in that case, 80 is the gain that is recorded as capital reduction. This is the most common format of capital reduction. Sometimes what happens is face value is 100, paid up value is let us say 60. This paid up value only we are bringing it down to let us say 30. Means face value will remain 100, but this will come down to 30. So in that case, what we will do, we will debit the share capital account by 30. Here I have taken the example of 40 to capital reduction 40. So basically, if we are cancelling out any share capital, sometimes it may happen a new face value is being introduced. Then debit the entire old face value, create the new face value. Sometimes if you are only reducing the paid up value, just reduce the share capital amount. Any gain goes to capital reduction account. Any gain goes to capital reduction account. Then sometimes what happens is
It's 2:30.
Sometimes what happens is face value is 100, paid up is 80, and it has brought down to 80 paid up. Then there is no gain. There is no gain. Earlier also it was 80 paid up, now also it is 80 paid up, but face value is no longer 100, face value is only 80. So then you will change it from face value 100 to face value 80. But in the examination, most of the time what you will get is this. This is what you have to focus on for the examination, right? Then another thing what consistently happens in Enroll construction is appreciation of asset or reduction in liability. This represents a gain, and overvaluation of asset and debit balance of P&L account which has to be written off. This represents a loss. Then you have your liabilities. So generally what you have to understand is whenever we are doing a reconstruction activity, net there will be a gain. Only then the reconstruction makes sense. If it's already a troubled company and after the reconstruction activity, if you are still making a loss, then it doesn't make sense. So normally you will have some reduction in liability, some increase in liability also. But net there will be a reduction in liability and appreciation of asset. Yes, there may be some depreciation in asset also. We may write off assets which are overvalued. We will have to write off debit balance in P&L. That I'll come in the subsequent discussion when I'm doing a problem. Okay. Now the way to approach a reconstruction related problem is, so generally what they'll ask you, journal entries, capital reduction account, you may have to prepare a bank account. Okay, that is what is tested. Now if you are confused with journal entries, you can start with capital reduction account. So first prepare the capital reduction account, record all the losses, that is increase in liabilities, decrease in assets, record all the gains, decrease in liabilities, increase in assets. Okay, and if at all there is an equity involvement, normal there will be a gain, so you can say reduce in equity. All of this you will record in capital reduction account. All of this you will record in capital reduction account. Then you will have a gain. This gain will be used to write off debit balance in P&L account, fictitious assets, and now please note, goodwill or any other intangible asset you will write off only if it is given in the question. If they don't say anything about goodwill, don't go ahead and write off goodwill. Okay, and after doing all this activity, if some balance is left, that will be transferred to your capital reserve. Okay, so now what we will do is, first we will take up a question from the examination, and then we will take a couple of questions from the material. Another 14 marks question, and with right kind of approach and structure, you can score good marks here as well. Following is the summarized balance sheets of Z Limited on 31st March of 24. Equity and liability, share capital, they have given equity shares, preference shares, debentures, these numbers are given. Then you have trade payables, 1 crore 15 lakhs 80,000. You have asset of goodwill, 81,000. Property, plant and equipment, 72 lakhs, 13 lakhs 75. Trade receivable, inventories, cash at bank, owned debentures, 576. Owned debentures means they have, actually you don't show it anymore in the balance sheet. They have repurchased their own debentures, which has to be, cancelled. P&L 1235. On 1st of April, court approved the following reconstruction scheme for Z Limited. So, on 1st of April, it is approved. Each equity share shall be subdivided into 10 equity shares of 10 each, fully paid up. After subdivision, equity share capital will be reduced by 40%. So, sometimes they will say 240%, sometimes they will say by 40%. By 40% means what? You have equity of 60 lakhs. Into 40% is the reduction. And this 100 shares each, nominal value, will be brought down to what? You will first subdivide into 10 of 10 each. So now a notional entry or a nominal entry or nominal entry that will be passed, that is 10 face value and 100 face value, right? So 100 face value and 10 face value. So you will debit 100 and you will credit 10, and then you will reduce 40%. Preference share dividends are in arrears for last 4 years. Preference shareholders agreed to waive 75% of the dividend and accept payment for the balance. So what? 4 years it is outstanding. So we will calculate how much is outstanding for 4 years. Then 75% you will waive, means they will not take it. They don't want it. Balance 25%, they accepted payment for balance, means what? You will pay through the bank account, right? Then owned debentures 240 nominal value were sold at 98 come interest, and remaining owned debentures were cancelled. So 240 nominal value were sold at 98. 98 means into 98%. So whatever is the loss you will recognize, and balance you will cancel. Debenture holders of 6 lakhs agreed to accept one machinery of book value of 9 lakhs in full settlement. Now what does this mean? I have a liability of 6 lakhs and giving them an asset of 9 lakhs. So 9 lakhs minus 6 lakhs, I am incurring a loss of 3 lakhs. I am giving them something worth 3 lakhs extra. Remaining PPE were valued at 60 lakhs. So from the PPE of 72 lakhs, you will remove 9 lakhs and balance whatever is left. So 72 minus 9 is 61. You will value the remaining at 60 lakhs, means there is a 1 lakh loss. Trade payable, trade receivable and inventories were valued at 15, 13 and 944 respectively. Goodwill and P&L are to be written off. Company paid 60,000 as penalty to avoid capital commitments of 12 lakhs. So when you pay something as a penalty, it's a loss, you will debit to capital reduction account. Interest on 10% debentures is paid every year on 31st of March. Pass the necessary journal entries in the books of Z Limited. Prepare capital reduction, prepare bank account. So now, what you have to understand is, if you are confused with the journal entries, you start with capital reduction and bank account, and simultaneously keep posting the entries. So when you post something in capital reduction account, so first prepare the capital reduction account, then bank account, and then you can combine the entries and pass the necessary journal entries. Okay, so let us take adjustment by adjustment. First, each equity share shall be subdivided into 10 of 10 each. So first what you will do, you will pass this nominal entry 100 to 10. Debit equity share capital 100, credit equity share capital 10. Then 40% of this is written off. So 24 lakhs is my gain. This is my capital reduction account entry. This does not have an impact on the capital reduction account. So when you come to the capital reduction account, you would say by equity share capital 24 lakhs. Then preference shares dividends are in arrear for last 4 years. Preference shares agreed to waive of 75% and you have to pay only 25%. Means what? Out of 4 years, you have to pay only 25%. That is, you have to pay only for 1 year. Now you are making a payment it is like a loss. See, actually, technically you can reduce it from reserves, but here, do I have anything to reduce from the reserves? I don't have. I don't have a general reserve from where I can pay the dividend. So, whatever dividend I am paying, it is like a loss to me. So, for preference shares, you have 21 lakhs into 8% into 4 into 25%. So, basically 21 lakhs into 8%. How much is that? 21 lakhs into 8%, that comes to 1,68,000. So 1,68,000 is what you will pay. Now to pay this dividend, generally I will use my revenue reserves, but my debit P&L itself is in debit balance. So how will I pay it? So what I will do, I will pay this 1,68,000 and debit it to capital reduction account. So the loss capital reduction account to bank. Sir, why to bank? Because we have paid the dividend 1,68,000, 1,68,000. Okay. Then own debentures of 2,40,000 nominal value were sold at 98. So when we sell 240 into 98, how much is that? 2,40,000. 2,40,000 into 98%. So, sorry, 240, 1, 2, 3 into 98%. That comes to 235,200. This is the value that we have received. Okay. Now, if you come back here in the balance sheet, we have 6 lakhs nominal value. Cost is 5,76,000. 6 lakhs nominal value. Cost is 5,76,000. How much did we sell? We sold 240 nominal value. What is the cost of that? So that will be 2,40,000 divided by 6 lakhs into 5,76,000. So that is how we will calculate the cost. So 2,40,000 divided by 6 multiplied by 576, cost is 230,400. Whatever is the profit, this will go to, this is the profit, this will go to capital reduction. Okay, so the capital reduction is 4,800. This is the sale value, which is 98%. This is the cost and this is the profit. This you will post it to capital reduction account. This you will post it to bank account. Then now when there are two entries in bank account, you will have two own debentures to capital reduction. So if you see the bank account entry, to own debenture, and also you should have to capital reduction. This is own debenture, this is capital reduction. Then the remaining debentures were cancelled. Now what is the remaining debenture? 240 we have sold. So we are left with, if 240 is sold, how much are we left with? 360. 360 we are left with. This 360 we will cancel, right? So when we cancel this, we will make some profit. Why profit? Because this is the liability component. And how much is the cost of that? 360 into, I think it is 576, yes. 576 divided by 600 cost. So the cost is 360 into 576 divided by 600, 345, 600. So on my asset side I have 345, 600. Liability side it is 360. Why 360? Because my debenture liability will be at nominal value. So 360 minus 345, that is around 14,400 is the gain. So 360 the debenture liability, own debenture this is at cost, and capital reduction 14,400. This is the gain. Okay. Then debenture holders of 6 lakhs agreed to accept one machinery of book value 9 lakhs. Now if we come to debentures, here debentures we have 18 lakhs in total. Out of this 18 lakhs, 6 lakhs is our own debenture. Out of that we sold something and remaining we have cancelled. How much is cancelled? The cancelled amount is 360. So out of this 18 lakhs we have cancelled 360. Then another 9 lakhs, oh sorry 6 lakhs. Another 6 lakhs, what they are saying is you give us a machinery worth 9 lakhs. So from here 72 lakhs, a machinery worth 9 lakh is given. So machine is going out. So what you will do? To machinery 9 lakhs. Debentures, how much? 6 lakhs. So 6 lakhs of debenture liability going down, 9 lakh of machinery going down, there is a loss which will be booked to capital reduction 3 lakhs. So capital reduction loss 3 lakhs, 10% debenture 6 lakhs, machinery 9 lakhs. Then out of 72 lakhs, 9 lakhs is taken over. So we are left with, I think I told 61 at that point of time, it is 63 lakhs. 63 lakhs is the PPE balance. Now it is valued at 60 lakhs. So you are left with 3 lakhs. That 3 lakhs is your loss because you are undervaluing. Then trade payables, trade receivables and inventory, they have given us the numbers directly that it has to be valued at respective number. The differences will be booked to capital reduction account. This is a simple adjustment. Then whatever is the balance in goodwill and whatever is the balance in the debit balance of P&L, that will be written off. Then there was a liability which was paid 60,000, that also will debit to capital reduction. Then what you can do is in the capital reduction account, after you post all the entries, whatever is left over, this balancing figure will go to capital reserve, right? And in the bank account, what all will get? In the bank account, the opening balance, then this is the dividend you have paid, right? Then this is the commitment you have settled, then this is the debenture which is sold. So the moment you see a bank entry in the journal entry, you post that in the ledger. Okay, they have not asked the balance sheet because it will become a lengthy question after that. Now if you ask me, sir, marks allocation, each entry, most of the entries will be 1 mark. This entry may be for 2 marks. Most of the entries will be for 1 mark. So maybe 11 journal entries, 11 marks here. This capital reduction account 2 marks here, and this 1 mark here. 11 plus 2, 13 plus 1, 14. Or you can have maybe 10 marks here, 1 more extra marks for capital reduction account. Now the thing what I am trying to tell you here is, in this capital reduction account and in the journal entries, even if you don't know, for example, sir, this was very confusing. It may happen, right? This cancellation may be confusing, okay, or the sale of debentures may be confusing. First time you have seen that adjustment, no worries. Can I write these entries? 1, 2, 3. Can I write these entries? 6, 7, 8. Whatever entries I write. So if let us say out of 10 I write 6 entries or 7 entries correctly, I will get 7 marks for this. 2 marks for capital reduction, 1 mark for bank account. That is how we can score. Even if the language is twisted, if the language is confusing, by doing that you can definitely score good marks in the examination. See, 3 chapters we have done. In 3 chapters, if you target, of course we would like you to score 14 out of 14, but sometimes the adjustment is complex. So why not try, even if 8 to 10 marks in each of this, by spending 1.5 hours, if you can secure 30 marks in this, MCQs 20 marks through, and whatever extra marks comes will be your bonus. Whatever extra marks comes will be your bonus. And MCQs with your conceptual clarity, you will be able to handle it very well. Okay, so that is one thing. Now I'll do one more problem on reconstruction. This one. Again, as I told you, reconstruction is all about understanding these complex adjustments. That's it. Okay, nothing beyond this. If you can understand this complex adjustment, passing journal entries will not be a challenge at all. Yes, how to prepare balance sheet after you do the pass the entries? With each journal entries, what is the amount to be reduced? You have to reduce from the respective amounts, right? So let us see this. Given below is the summarized balance sheet of Rebuild Limited. Authorized and issued capital 12,000, 7% preference shares. Preference dividend is in arrear. 15,000 equity shares. Trade payable, other liabilities, loan, building 4 lakhs, 2 lakhs 68, 3 lakh 18, trademark and goodwill. Don't write this off unless the question asks you. Okay. Inventory, trade receivable and P&L balance. The company is now earning profit short of working capital and a reconstruction have been approved. The summary of the scheme is the equity shareholders have agreed that their 50 shares, rupees 50 shares should be reduced to 2.5 by cancellation of 47.5 per share. They have also agreed to subscribe for 3 new equity shares of 2.5 each for each equity share held. Now what does that mean? From rupees 50 you have to bring it down to 2.5, means there is a gain of 47.5. That is the first thing. Second thing is, whatever is the number of shares, 15,000, they will subscribe to 45,000 shares at how much? 2 rupees 50 paise each. So this is a separate entry where you are getting a fresh subscription and this is the reduction part. So what is the requirement of the question? Show by journal entries how financial books are affected by the scheme and prepare the balance sheet. So first is 50 reduction to 2.5. So this is just flip number. Okay, so this has to be 712 should be the capital reduction, and this has to be the equity share capital. Okay, then bank account, new shares subscribed. Okay, then the preference shareholders have agreed to cancel the arrears of dividend. See, the same adjustment is there in the examination, and to accept for each rupees 50 shares 4 new 5% preference shares of rupees 10 each plus 6 new equity shares of rupees 2.5 each, all credited as fully paid. Now what does this mean? The preference shareholders have agreed to cancel the arrears of dividend. So whatever is the dividend, we will not take. For each 50 shares, so we have a 50 shares of 12,000. 4 new shares of 10 each. So 4 shares of 10 each, that is 40 into 12,000. 48,000. No, sorry, 4,80,000. Then 6 equity shares of 2.5 each. 6 equity shares into 2.5. It is 15 into 12,000. 15 into 12,000. So 15 into 12,000 is 1,80,000. So 480 plus 180, 560. Balance is your capital reduction. So 480 plus 180, the total amount is 6 lakhs. There is a capital reduction loss of 60,000. Okay. So why did we take a loss? Maybe because we have waived off the dividend. And dividend, because it is not appearing in the book, it will not impact the capital reduction. Right? Then lenders to the company for 1,50,000 have agreed to convert their loan into share, and for this they will be allotted 12,000 new preference shares of 10 each and 12,000 new equity shares of 2.5 each. So 12,000 preference shares into 10 each, that is 1,20,000. You will credit the preference shares account, and 12,000 into 2.5, 12,000 into 2.5. So 12 to the 24, 24 plus 6, 30. Okay, so 120 plus 30, 150. This is also 150. So no gain, no loss. So here 1,50,000 loan is written off. New capital, new capital. The directors have agreed to subscribe in cash 40,000 new equity shares of 2.5 each, in addition to any shares to be subscribed by them under 1. So 40,000 new equity shares into 2.5, 1 lakh. So we'll get another 1 lakh, 1 lakh. Then of the cash received by the issue of new shares, 2 lakhs is to be used to reduce the loan due by the company. So how much is the loan? Loan is 5,73,000. Out of that, we paid off some loan here, 1,20,000. Sorry, 1,50,000. Further, we will pay off 2 lakhs. So you will debit the loan amount cash. The equity share capital cancelled is to be applied to write off debit balance in P&L and 35,000 from the value of the plant. So whatever is the debit balance in the P&L, 35,000 from the plant and debit balance in the P&L. So what we will do? 35,000 here and debit balance in P&L 451. Then any balance remaining is to be used to write down the value of trademarks and goodwill. Okay, so after you write off P&L, after you write off plant, 35,000 plant and debit balance in the P&L, balance will go to trademark and goodwill. Okay, so this is plant. Okay, P&L balance was how much? P&L balance was 451 that we have written off. Balance will go to trademark and goodwill, that is 166,500. Okay, so now for this, I would suggest to prepare a working note for capital reduction account as well, so that you get to know what is the balance that can be used to write off the trademarks and goodwill. Okay, now while preparing the balance sheet, the thing you have to keep in mind is for each adjustment there is a number that has changed. Okay, with practice you will be able to figure out where to change and how much to change and what to change. That is definitely there. But what you can do is, for example, equity share capital, it has come down from 7,50,000 to 37,500. So that adjustment, either note it down in rough somewhere or prepare the notes to accounts directly. Prepare the notes to accounts directly. Right, now how do we get 1,80,000? So you have to take one by one. Here how much is the equity share, fresh share that has been subscribed to, here shares that has been issued to, then here equity share capital is there, here also you have equity share capital, right? So all of this put together, what is the total number? So that is how you have to trace. Each entry you have to see whether I have given the adjustment or not. Only then you will be able to solve the question. So for example, you have 15,000 shares. Okay. So with the first adjustment, it will be 15,000 shares. Then 3 shares have been subscribed. So this is 45,000. So 15,000 plus 45,000, 60,000. Then here preference shareholders 12 into 6, 72,000 plus 72,000 shares here. Then loan account 12,000 new equity shares, 12,000 new equity shares here. Okay, here loan account. Then subscriber directors, I think 1 lakh shares. So like this, you have to do a total, not 1 lakh. 1 lakh is the value. I think 40,000 shares. Yeah, 40,000 shares, right? Yeah. So like this, what you have to do is you have to total up. Then you will get to the number. Okay. So for equity shares, we have 1,80,000 equity shares, 60,000 preference shares. Like that, you will get to the numbers. So if you miss anything, the balance sheet will be a problem. Okay. Same way, let us say loan account has been reduced here by 1,50,000. Another loan account is reduced here by 82,500. So from the total balance in the question, remove 150, 82. So like that, if you follow step-by-step approach, preparing balance sheet will not be a challenge again. If your balance sheet is not matching, then you have missed out one or the other adjustment. Okay, so this is how we should approach the capital reduction related question. I hope I have been able to revise this quickly. If you have any questions, you can ask me. Low budget edits, physics wala is better. What is your monthly salary? See, I am not here to discuss my salary or who is better, who is not better. All teachers have their own qualities, and if they are better, they are better. I am not comparing with them. I am here to help my students. Sir, can you explain the second adjustment? I have already explained that. Sir, can you kindly tell the principal rule of internal reconstruction? My video is paused because my phone is off. So my audio is still coming to you, and I think that is sufficient. Right, internal reconstruction principle. See, the way you have to solve the question in internal reconstruction, I'll give you a very simple technique. This is the capital reduction account. By doing any adjustment, if there is a gain, record it on the credit side. If there is a loss, record it on the debit side. If you follow this principle, 95% of the adjustments you will be able to handle. Like for example, here we saw loan account of 1,50,000 settled by issuance of preference share capital and equity share. There was nothing, sorry. Here for, let us say, preference shares. Okay, what did the preference shareholders say? They said, we don't want our dividends. Okay, we cancelled the existing shares of 6 lakhs. We gave them new preference shares of 4,80,000 and new equity shares of 1,80,000. So 480 plus 180, this itself made it 660. Existing liability was 6 lakhs. We gave them 660. Loss is how much? Loss is 60,000. So if the loss is 60,000, I am debiting to capital reduction account, and when I am preparing the capital reduction account, I will put it on the debit side. I'll put it on the debit side. Same way, if there is a gain, I'll put it on the credit side. Right? So I hope with this discussion we had over the last 5 hours with half an hour of about 1 hour of break, you have been able to quickly revise and recap and find out the focus areas for these 3 difficult chapters. Okay, those of you want accounting standards related revision and all, that's already there on YouTube. Okay, and the remaining time to the examination, few things I would like to share with you when you are approaching your examination. During the 3 hours of examination, this 30 marks of MCQ that you get, you should allocate and try to finish it within 20 to 25 minutes, maximum 30 to 35 minutes. I know it can be challenging, but it is faster than solving a proper question. Okay, then there are questions which are standard. For example, accounting standard 2 on inventory, borrowing cost related topic, right? Then construction contract related completion. There are some standard questions which are tested. And one thing what I observed in May 24 paper, if you see, the paper is slightly lengthy. Because you have MCQ, they have put a paper which is slightly lengthy. So if I just have to, showcase to you how this question paper looks like. Right, now this is a question for 7 marks and 7 marks each. Okay, and if you see this, calculate the amount of borrowing cost, pass the journal entry, depreciation, carrying value of the building. Four items are there, and if you see the answer, okay, normally this level of working you will get 2 to 3 marks. Journal entry 2 marks. This is done. Then this is 1 mark. This is 1 mark. Then this is another 2 marks. Okay. Then this is another 1 mark. If you see the technical breakup, so you have 1 marks plus 2 marks, 3 plus 4 plus 5 6 plus 2 8 plus 2 10. So actually they are trying to compress a 8 to 10 mark question into a 7 mark question. Same way this inventory question. The inventory question is also long, pretty long. Okay, so what you have to do is, because now they have changed the structure, they want it 7 and 7 marks. What you have to do is, the questions that you can handle well and easily, if you feel, first try to finish them off. And as I told you, A16, this question, this is a standard question.
It's 3 o'clock.
And today or tomorrow I'll be releasing the updated compiler as well. So if you look at the compiler, there are some common types of questions. If you are comfortable with them, you will be able to handle the examination pressures pretty well, right? Then there are high scoring topic like cash flow, financial statements, if at all they ask, if you are lucky. Okay, and we discussed these 3 topics. These are also high scoring. Don't be scared. There is a very much hype created around consolidation, amalgamation, and all of that. These are not really difficult topics. If you are clear with those steps and basics, you will be able to handle. Again, because there is a difficult adjustment, please don't leave the question. You may do it at the end, but please do not leave the question. And internal reconstruction, what you have to do is take at least 7 to 8 questions and see if you are able to handle the adjustments independently. Because internal reconstruction is all about the adjustments only. Thanks for taking your time and joining in for this live session. Okay, and all the best for your September examination. Trust your preparation, even if you are 80% prepared, 90% prepared, whatever is the level of preparation. Trust your preparation and do the best in your examination. Thanks a lot once again.